view is that we probably won't see cuts until unemployment gets closer to 5%, which is what I think many at the Fed believe is the current NAIRU.
Wow. Annetta, great to have you, especially in a moment like this. Thanks so much for your time.
Thank you for having me.
Annetta Markowska with Jefferies. And coming up, home equity is still sitting at record levels. And a new report predicts owners will be putting it to work next year as rates climb. The impact on consumer spending and the latest mortgage demand data are next. As we head to break, don't want to call it, but, markets look like they're getting their hopes up a little bit about this Fed meeting. Dow drifting to session highs, up 265, pretty much up 0.8% across the board. Will these hopes be validated or destroyed? Stay tuned in 14 minutes. We'll be back in 2.
ICVX.
Welcome back. Got to check in on the housing market, where we see mortgage applications back on the rise after 4 straight weeks of declines, but demand still way off from this time last year. Let's get to Diana Olick with the numbers. Diana?
Well, Kelly, it took a while for them to really react to those lower rates, but after a month of declines, mortgage application volume finally rose last week thanks to those lower rates. The average rate on the 30-year fixed for conforming loans did increase ever so slightly last week to 6.42% from 6.41 on the MBA survey, but the trajectory for rates has been lower for the past month as government reports showed inflation was cooling and interest rates dropped sharply yesterday after the CPI release. So as a result, applications to refinance a home loan rose 3% last week from the previous week. Of course, they're still down 85% from the same week 1 year ago. Still not a ton of people who can benefit given the record low rates we saw during the first 2 years of the pandemic. Now, mortgage applications to buy a home rose 4% for the week, but were 38% lower than the same week 1 year ago. That annual comparison, though, is now shrinking slightly as rates drop. Lower rates have shrunk demand for adjustable rate mortgages. ARMs dropped to 7.7% of total applications last week from just under 13% in October. And we could actually see growth in another type of home loan, home equity loans and lines of credit. TransUnion is forecasting that home equity originations will increase by 24% in 2023 from this year as homeowners tap into about $19 trillion in collective home equity, Kelly.
Which makes sense and could prolong consumer spending, but does it increase the fragility if all of a sudden home prices start to wobble and decline?
Yeah, well, if home prices start to weaken a little bit, it could. But remember, what they're trading this home equity for is actually lowering their rates on other debts. So that's what we're asking. Why are they using the home equity? It's not to renovate their homes so much, but really more to consolidate their other debt and pay it off, that debt that has higher interest rates now.
Now, that sounds financially savvy, let's call it.
Does.
Diana, thank you. Diana Olick.
Sure.
Everybody, we are less than 10 minutes from the Fed's rate decision, and Power Lunch picks up our coverage after this quick break. The Dow's up 231. Stay with us.
Check one.
Game. ICVX.
All right, CNBC is running a little bit behind, so we're going to announce the rate hike here in the chat as soon as it becomes available. Market is expecting the 0.5 rate hike. We'll see if that's what we get.
Hi, everybody. Welcome to Power Lunch. I'm Kelly Evans along with Dom Chu. Welcome.
It's good to be here.
It's going to be a quite busy afternoon here.
Is there a Fed decision today?
There is. We are just about 5 minutes away from the Fed's decision on interest rates, and a half-point hike is widely the expectation. We also get the dots, those projections. They're going to offer us clues on how much further policymakers expect rates to go.
Now, stocks are near recession highs right now, so much for wait and see. The Dow, the S&P, and the NASDAQ, as you can kind of see there, moving higher to the tune of around maybe of 0.5% or so at this stage here. We've got a big Fed panel today. JP Morgan Asset Management's David Kelly Mona Mahajan with Edward Jones, also John Bellows with Western Asset Management Company, WAMCO as we used to call it back in the day. Thanks everyone for being here as part of this program. Let's start perhaps, Mona Mahajan, with you, with just the expectations that you have from an investment strategy standpoint on whether people need to do anything with their money in the wake of what we're going to get from the Fed today.
Yeah, look, it's a great point. I don't think necessarily we need to move money before or after this Fed meeting. But what we will be watching for, of course, is that dot plot. And really what we're looking for is to see if the markets and the Fed are converging towards the same terminal rate. So right now, markets are expecting this 5.25% terminal rate. If the Fed kind of implicitly blesses that level, we see a dot plot that also leads to a 5.25% terminal rate. That, in fact, may provide the market a bit of comfort that we are closer to the end of this Fed tightening cycle, but also perhaps after that we'll get this pause. And then what will be really interesting to see is if they start putting in any sort of rate cuts for 2024 and beyond. And we think the markets will really look forward to when the Fed may not only pause, but move rates lower once again. And that will really stimulate the market rebound. But generally speaking, we think we're towards the end of potentially this bear market. Any volatility in the months ahead will provide that opportunity to position for what we think will be a better market backdrop and potential recovery in 2024.
John, the market right now is pricing in a certain expectation, and we got a little bit of a movement, if you will, in some of those Fed fund futures and the interest rate markets, given what we saw with the consumer price index, softer than expected this past week here, just yesterday. I wonder, do you, in your mind, feel as though the markets are appropriately positioned? In other words, are the expectations correct for that so-called ending of the Fed cycle with a terminal or ending rate in that kind of, we'll call it 4.75% at this stage?
I think you're right. CPI yesterday was important, and I think it was important for two reasons. The first is that I think the Fed is moving towards a more forward-looking policy. Over the summer and through the early fall, they were just reacting. CPI was too high, and they were constantly on their back foot and reacting to those numbers. Reactive policy is problematic. Looking in the rearview mirror is not the best way to do policy, and the Fed is very happy to finally be more forward-looking. And so I think CPI yesterday and also the month before is going to allow them to be more forward-looking in their policy. I think you're going to hear that from Powell today, and I think that's generally a very positive thing. I think the other thing that's important about CPI yesterday is after today's hike, it'll be the case that the policy rate will likely be higher than the run rate for core inflation. That's the first time all year that's been true. And I think the Fed is going to look at that and have a little bit more confidence that policy is restrictive. CPI may still be too high, although I think that's debatable. But with a policy rate that's now higher than the run rate of core inflation, it becomes just a matter of time before inflation starts coming down. And I think that's another big development. So I think generally speaking, CPI yesterday was a big deal because it kind of enforces both those points. The Fed can be more forward-looking, and now after today's hike, we have a policy rate above the inflation rate, and that's a big development and important for forward-looking expectations.
All right, and David, we've just got a few moments here left before the decision comes out. You've seen a lot of these decisions before. This year, the numbers suggest that there's been a lot more volatility around Fed rate decisions with the markets. Do you expect that today?
Not really. I think people priced in 50 basis points. I think the dot plot will go up 25 basis points, but still a terminal rate of 4.75 to 5%. I think Jay Powell will actually smile during his press conference because there is better news on inflation. I think he'll have to admit it. That opens the window a little wider for soft landing. So I think we're in a good place here, and I think market expectations and the Fed's view are converging here, and I think that's a positive.
All right, there's the 10-year yield,
And there it is.
3.51%. Let's call it ahead
We're
of the
at
Fed
the
decision.
0.5 rate hike is in.
WTI
0.5
oil
rate hike is in, and the market
the
didn't
S&P
like
up
it.
about 0.75%. And let's get to Steve Leisman with the Fed decision. Steve.
SPY giving back all its gains, going negative for the
Federal
day
Reserve
on the
raising
rate
interest
hike
rates
of
by 50
0.5.
basis points to a new range of 4.25% to 4.5% as expected. The Fed saying ongoing rate hikes will be appropriate. The Fed also raising the 2023 median forecast of Fed officials went up to 5.1%. It had been at 4.6%. This is higher than market expectations for a peak funds rate. It is, by the way, right in line with the Fed survey at 5.15. 17 of the 19 officials are now above 5% in their forecast for the 2023 funds rate. None were above 5 in the September forecast. 7 officials, in fact, are at 540, and there's one person who's at 563 for all the way through 2025. The funds rate then see going down to 4.1% in 2024, 3.1 in 2025, with a long run rate eventually being reached of 2.5%. The Fed repeats it will take account of the cumulative effect of rate hikes and lags in setting policy. This is again from the statement. It will continue to reduce the balance sheet by $95 billion a month. It says growth has been modest, inflation elevated, unemployment low, and job gains robust. So it still sees that tight job market out there. It raised the GDP this year to 0.5 from 0.2. That's because of the strength we've seen in the fourth quarter, but it lowered it to just 0.5 point for next year from 1.2. Ratcheted up a bit the unemployment rate to 4.6 from 4.4 for next year. Stays there for 2 years, by the way. And it sees inflation gradually declining to 2% by 2025. So 50 basis points, Kelly, but pretty hawkish when it comes to the outlook. And good unanimity, by the way. The statement, the policy decision was unanimous. Good unanimity also, at least by the board right now, on where rates are headed, and that it's above 5%.
Hawkish, Steve, is the conclusion from markets where we've seen stocks lose all of their gains, in some cases turn negative, and the 10-year yield up about 3.5 basis points. Again, this is the first reaction. It's going to be a long afternoon. We have maybe 2 hours until we're done hearing from Powell. That said, what's the most hawkish thing about this to you? Is it those rate hike projections, the dots as we call them, especially into next year in 2024?
So there's a discussion that I think we can have, Kelly, maybe in one of your regular terrific 1 o'clock shows, not the special, about whether the Fed is now using the dots as more of a policy tool. And I think the Fed's sending a message here that while the market has taken all this very dovishly, loosened up financial conditions, that part of this is a message, hey, we're going above 5%. We intend to be very tough here when it comes to inflation. So that 5.1%, not just by itself, but the number of people, the change from the September survey, none of them were above 5% before, and many of them now being above, what did I say here? 17 officials now above 5. 7 officials are at 540 or higher. So there was a pretty hawkish, sizably hawkish contingent on the Federal Reserve right now.
It sure sounds like the consensus, so to speak, is changing around that, Steve. All right, so stick around, please. We're going to talk with you a lot more, I'm sure, about this. Let's bring in our panel as well. Again, we've got a lot of folks out there, and let's bring in and introduce Bob Pisani as well. Also, Rick Santelli joins the conversation. So this group, as you can see in front of you here, has a lot of expertise, and maybe we'll send it out to Rick first with some of the reaction on the interest rate and macro side of things. It wasn't for sure, Rick. It was definitely movement in the marketplace, but it was nothing that was, I would characterize as being unexpected or out of the ordinary. Markets did move, but not by a whole heck of a lot.
No, and when you set the table for interest rates, to give some context, they have been moving rather dramatically lower considering the Fed's path. And today we see that 2-year notes spiked up. They spiked up towards 426-ish, and they're coming back down a bit, but they're a little more sticky than 10s, which popped up to right under 355, came back down a bit. These are not huge moves, and in the context of the fact that we're even near 350 after having a 4.25 high yield close for 10s or 470 high yield close for 2-year, and now hovering at what, 422, 423? These rates are low, and when you look at dot plots and how far out they're predicting inflation's going to be stubborn, something isn't squaring here. And it's going to be interesting to hear the Q&A because the markets have definitely become very opinionated and investors are pushing back more in the treasuries than they are in equities. Yes, the equity knee-jerk reaction was down, but it wasn't huge. And if you look at the spreads, 2s to 10s inverted a several basis points more, and the dollar index improved a bit. That latter, I think the dollar index will be a good tell during the Q&A.
And we go to Bob Pisani for more on these stock moves that we're seeing. Bob, what do you make of it?
Well, I think Dom's got it right. We were down about 300 points peak to trough in the few minutes after the Fed announcement came back, and we're now flattish essentially on the Dow. So the market has been looking to break out of 4,100 on the S&P. Why? Because that would break the downtrend, this pattern of lower lows and lower highs we've had all year. But we've had a lot of resistance there. We failed several times. We had a strong PPI last week. We went to 3,900. So the hope here is you either break out above 4,100 or you grind around at 3,900 or so, because that seems to be where there's a lot of support. And it looks like grinding around might be the thing to do at this point. The real problem here is Wall Street is dramatically lowering the earnings estimates for 2023 because inflation is a 2022 story. Recession is the 2023 story. What side of the recession debate are you on? And most major strategists now anticipate flat to negative earnings. 0 to down 10% is the range of the estimates for strategists on Wall Street. The average is about down 5%. So this is the problem. How do you argue for higher stock prices from here when you're in the middle of what Wall Street thinks is going to be a fairly mild earnings recession? Let's put it this way. Down 5% on earnings would be a mild earnings recession. Down 20% would be a harder landing in terms of recession. But how do you argue the S&P should be higher 6 months from now or even 8 months from now when you're potentially down 6 to 10% on earnings in 2023? That's a hard case to make right now. You'd have to argue for a multiple expansion, and Dom knows perfectly well that's a pretty hard thing to argue in a downward trending economic environment.
You know, Bob, it's an excellent point, and one that many traders have been talking about for maybe weeks now at this point, is to see whether there is that kind of a breakout. This data, this Fed rate decision did not do anything to change anything from that trend standpoint. David Kelly, I'd like to bring you and the rest of the panel back into the discussion here. David, the markets are reacting, no doubt about it, and equities are softer. They've moved to the downside. We've seen rates spike higher, but it all in the context of where we've been over the last several weeks seems as though the markets were kind of anticipating this. What does this now say about the way that the landscape sets up for the early part of 2023 and whether the Fed will continue its rate hike campaign, albeit perhaps at a slower pace, or for a little bit longer than it did, but with smaller increments?
Well, I think the market was anticipating something more dovish in the dots than we've got here, because if you look at the Fed funds futures market as of this morning, it was looking at a terminal rate between 4.75 and 5, not between 5 and 5.25. But what I think is really interesting is, in some ways, the Fed is more hawkish than that, because what they're saying is that by the end of the year, they'll still be between 5 and 5.25 at the end of 2023. And as of this morning, futures markets were pricing in the idea that the Fed is already going too far and will have to cut rates twice at the end of this year. So I think there's going to be a major argument here sort of between the Fed and the markets, where the markets are saying you're overdoing it, you're going to put this economy into recession here, and that's why you're going to end up having to reverse course. So I do think I think this is a mistake. I think the Fed is trying to be hawkish to show how resolute they are against inflation, but inflation's fading anyway, and it's not worth putting the economy into recession just to hit your inflation target a year earlier than you thought you were going to. Inflation's coming down anyway, so I'm disappointed by this, but I think this is more hawkish than markets expected.
Although, John Bellows, let's remember how dovish the dots turned out to be coming into this year and how wildly they underestimated the actual trajectory of inflation and rate hikes. So could we live through an episode like that again, to David's point, where the Fed does come around to the markets? If anything, the dots are one of the most lagging indicators that we have.
Yeah, I think you're on a good point. There certainly is a little bit of a dissonance between the dots and the market. But the thing I would emphasize is that the degree of that is much smaller than it has been, and certainly much smaller than the volatility that we've realized in the market, over the last 9 months. So we've been in a market where the surprises have been very large, and the Fed surprises have been even larger, and that's been really challenging. It's been challenging for equities, it's been challenging for bonds, and as we progress, we're getting closer to the point where there is a convergence. There is a little bit more clarity on the outlook. I think Powell in his press conference is going to talk a lot about kind of his forward-looking expectations. And we're going to see less volatility as a consequence. And I think that's generally a good thing. So the thing I would emphasize here is there's a little bit of dissonance left, but it's a degree smaller, multiple degrees smaller than the volatility we've experienced. And that's a big transition. And it's a transition that I think will generally be supportive of financial markets, some resolution of the uncertainty, some convergence, and that forward-looking policy that I said earlier. I think that's generally a good thing, and I think that's where we're headed.
All right, so viewers, an update for you guys right now, and those listening on Sirius XM channel 112. Markets are at session lows. The NASDAQ Composite is off almost 100 points. The S&P is down about 27, 28 handles, call it. That just kind of, so to speak, I'm checking it right now, down about 20. so half of 1% declines. The Dow is now down 165, 170 some points. Mona, this is a good time to bring you back into the conversation here as well. We started you off with kind of the macro picture and what the expectations were. The way that the markets are shaping up right now seems to indicate, at least, that the initial part of next year could be a little bit more, say, biased to the downside, but maybe not as volatilely so as it's been. If you stack things up with the data that we've seen today from the Fed and the CPIs and the PPIs and everything else, does this then still mean that the path of least resistance for stocks is lower? Do we test the lows? Do we set new ones here in early 2023?
Yeah, it's a great point. And look, I think to John's point earlier, we are headed towards a 5% plus terminal rate according to today's dot plot, but really the market wasn't too far off of that. And so 5% or so means probably 2 more 25 basis point rate hikes. Maybe the Fed is giving itself some room in case inflation does become more volatile. But I also agree with David that inflation is starting to show signs of rolling over. And there are several leading indicators that we follow that do indicate that inflation will probably continue to move in this downward direction. Interestingly, I do think the Fed is being a bit conservative, so they have 3.5% core inflation by the end of 2023. I think there have been so many calls that the Fed has been wrong on inflation to the upside that now they want to be a little bit more cautious to the downside, and perhaps the same way they're giving themselves a little bit of room in the Fed funds rate. Now, to your point on do we retest the lows, certainly we think there's a period of volatility ahead of us as we get through not only an economics downgrade, but the earnings downgrade that was mentioned earlier. But that being said, this is what we are calling the worst kept secret on Wall Street. You know, this recession or this period of economic downturn is well known and established by not only Wall Street, but a lot of people are talking about it already. Yeah. We do think that if markets do enter a period of volatility, it could potentially be short-lived in that they will start very quickly then looking towards this period of recovery ahead. And keep in mind, when you do look at history, the analysis shows us that markets actually start recovering anywhere from 3 to 6 months before a recession ends. And so these forward-looking markets, we think, continue in 2023 for sure. And really, we start transitioning from defensive portfolios to more recovery portfolios.
All right, let's turn back, get a kind of quick comment as we start to turn our attention to the Fed conference at 2:30. We hear from the chair himself. Rick, what will you be listening for?
You know, I would be listening for the notion that higher for longer, and I believe even if we start to show more dramatically heading towards a recession, I think the key to this move by the Fed, this whole tightening cycle, is that they're going to be much tougher to actually reverse and turn corners and lower rates. I think that's what you want to concentrate on. And if you look at May Fed fund futures, and I've been looking at May, that's been roughly the fulcrum between April, May, June, but it had a dramatic break. A very dramatic break. And my phone was going off because many of my sources that trade were telling me that changed the way they traded 2s, 10s, 30s in the stock market after watching the dramatic 10 basis point drop in May Fed fund futures.
All right, Steve Leisman, we're going to give the last word to you here as we wrap up this panel. The takeaway and what you will be listening for and asking Fed Chair Jay Powell during this press conference.
Here's the thing. There is now the need for a daily Leisman-Santelli show. Markets said what, Fed said what. I don't agree that we're heading for a period of lower volatility. I think there's more volatility because I think, you know, Rick is very focused on what the market is saying. My job is to report to you in detail what the Fed is saying. That gap grew today. Rick is right. We did have a strong move in that May 2023 contract up to 492 from 482, but it's still below where the Fed is. And more so when you look out the curve to the January 24, as I think Dave Kelly said earlier, the Federal Reserve sees itself ending the year at that 5 1/8 number, and the market thinks they're going to end in the 440 range. So there's 60, 70 basis points of difference between the markets. I think we have some discussions that have to be had, some explaining that has to be done about where the market is priced and where the Fed thinks we're going, and somebody's going to have to give something here. I don't necessarily think Kelly Evans was wrong earlier when she pointed out how wrong the Fed has been, but somebody's got to turn tail here, either the markets or the Fed, and this is going to be a very interesting story from here. I look forward to continued discussions with my colleague from Chicago, Rick Santelli.
All right, one of the best panels around to break down Fed decisions and economic data. Thanks to our panel, John Bellows, Mona Mahajan, David Kelly, as well as, of course, Steve Leisman, Bob Pisani, and Rick Santelli as well, Kelly.
So it gets even more interesting from here on out. Coming up, former Fed Governor Frederick Mishkin will tell us how high he thinks rates should go and for how long. Our analysis of the central bank decision continues with the press conference starting in less than 15 minutes' time. This often ends up being the real mover of financial markets. Don't go anywhere. We're back in just a moment.
Well, expecting a little bit of fear going into Jay Powell's speech coming up here. So maybe a little bit of fear until he either reassures us or absolutely destroys the market. Let's see what happens.
As 3 weeks.
All right, stocks drop, yields pop following the Fed's decision to raise interest rates by 0.5 percentage point to its highest level in 15 years. Let's now bring in former Federal Reserve Board Governor Frederick Mishkin. He is also a CNBC contributor. Thank you very much, sir, for joining us this afternoon. I wonder, you've had a few moments now to digest kind of what's happened. We're obviously all looking forward to this press conference. What exactly stood out to you, sir?
Well, I think the issue here is that the Fed is indicating that it has to raise rates. An issue I think that's very important is that they've slowed down the speed of raising rates. I'm not sure how critical that is in one sense, but it's important in another, in that, as Jay Powell has emphasized, the real issue is how high they have to go. I actually would have preferred to actually keep on the 75 basis point cycle for one more time. Because I think that actually that they have to go to higher rates than the market's anticipating, and also that the dot plots are indicating as well. So I actually also like to be more preemptive. Again, this has to do with the fact that they dropped preemption, which is a huge mistake. So I think that they have to get back to indicate they really are going to be ahead of the curve, and that they're going to be serious about not pivoting. That there are now calls for people to say, gee, the Fed should pause. Not too far in the distant future. I think they've got to do their job and indicate that that's what they're going to do to keep inflation under control, and that there is risk that in fact they could go too far, but it's worse to have risk that in fact inflation doesn't get back under control.
So you would have gone 75 here. That's interesting. I wonder what you make of the more forward-looking market indicators, the deeply inverted yield curves, especially the 10s ones, which has more or less a perfect track record. The fact that they've hiked now the Fed funds rate to well over where the rest of the curve really even is, except for at the very short term. Even something like prices paid of the ISM, right? The way that that's collapsed to levels consistent with 2% PCE inflation. Do those forward-looking indicators of inflation not tell you they're perhaps already too restrictive with policy here?
Well, I certainly don't think they're too restrictive, that's for sure, because what you have to think about is it's not the actual federal funds rate that's important. It's what we call the real federal funds rate, the federal funds rate that's adjusted for inflation. And even now, that's still not very high, because at least for the next couple of years, it's very likely that inflation is going to be not getting down below the 3% level, and that it's going to take a while longer than that. And so right now, they've only gone to sort of moderate tightening. It's not really, in fact, they've just really gotten to neutral just fairly recently. So from that perspective, I think that
but that's using current inflation. And inflation, as you know, is a lagging indicator. I mean, the inflation we're experiencing now is from monetary policy that was set into place 18 months ago.
Absolutely, but in terms of actually the kind of numbers that we see in terms of looking forward to what we think inflation is going to be, we don't really see numbers below 3% for a while. Now, I could be, actually, we might get lucky, and in fact, inflation would go below that. But I think expectations are really that inflation is still well above the Fed's target. And from that viewpoint, for quite a period of time, I'd like to see the Fed be a little bit tighter because they were a little bit too easy earlier on. So this is actually a judgment call. I think really what's more important is that the Fed actually signal that they're not going to just cave in and start to pause too early. That's what I really, really worry about. So in that case, it's not so much that I worry about the actual rise this time, but just where they're heading to. And that do they actually are willing to actually say that the risks that are more dangerous right now are not getting inflation under control rather than having the economy go into recession. And that's always a balance. But I think that there are a lot of people saying, gee, we're going to have a recession. Isn't that terrible? But in fact, in order to get inflation under control, that's what the Fed is going to have to do. You could look at past episodes that you always get a slowing in the economy when you're actually trying to get inflation under control. And that's even more true when you've actually gotten a little bit behind the curve, as the Fed has.
All right, so we've got just about maybe a minute or so left here. Frederick, before we let you go, is there a case to be made? A lot of folks, economists, are talking about this idea that interest rate policy has a long and variable lag. I've heard that term a lot now these days. Is there a case to be made that these days, this decade, that long and variable lag has become shorter, that we see policy impacts in as little as 3 to 6 to 9 months as opposed to 18, like Kelly pointed out before?
I really don't think so. I think that the lags are pretty long. And that's one of the reasons why it's not easy to be a central banker, that you've got to call the shots and sort of call the shots now for what you think is going to happen a year to 2 years from now. So I think that that's the age-old problem that central banks have, which is that they have to try to anticipate the future. It's not easy to do so. You can make some big mistakes that the Fed actually did make in this recent cycle. But that's just the job. It's part of what you have to do. And in fact, this is also an indication that you're operating under uncertainty, that sometimes you have to actually ask which of the balance of risks that you think are much more dangerous. And in this particular episode, not getting inflation under control right now is actually quite dangerous.
Sure.
So that's what I really worry about. And also the political pressures that are going to get much worse on the Fed. There are also people talking about raising the inflation target, which I think is not the right time to do so.
Okay. All right. Perfect. Great thoughts. Frederick Mishkin, former Fed governor, thank you very much. We appreciate it, sir.
And the press conference is next. Don't go anywhere.
FT app.
Welcome back. Let's get the lay of the land as we wait the Fed Chair's news conference. It starts in just a couple of minutes' time. We saw stocks. We'll talk to Mike Santoli down at the New York Stock Exchange. Mike, we saw stocks immediately sell off and yields pop a little bit on the decision. Everyone seems to think if Powell were to lean one way, hawkish would be that way. But there's still a risk he could open the door to use some language about needing to soften the pace depending on how the data comes in or something to that effect.
Without a doubt, Kelly. I mean, he can certainly acknowledge progress in various areas on inflation, those that he laid out not too long ago in that speech that the market took heart in. So, yes, I do think there is that opening. I think what the market is initially reacting to is not just the higher projected Fed funds rate where it's going to get to next year, but also in combination with the economic and inflation forecast that the committee put together, right? So they're saying growth is going to be worse than we thought 3 months ago, 0.5% GDP growth. That's as close as the Fed's going to get to predicting recession. And meanwhile, core inflation higher than we thought just 3 months ago. So that combination is unsettling. If they think inflation is going to be even higher while growth slows down, unemployment has to go up into the mid-4s is what they're saying. And even with that, they're going to keep Fed funds above 5%. Now, all that is subject to the markets disagreeing with it and deciding to take the other side. And you've been pointing out, and I think it's in all investors' heads, that 1 year ago, the Fed was very wide of the mark with what the outlook was going to be and what they were going to have to do. So at some point, you can fight the Fed if you feel as if their premises are not necessarily realistic.
But Mike, you can fight the Fed, but you're not going to do it from a career-long or short perspective if you don't have more data, right? I mean, is there anything that we're going to see between now and, say, the early part of January, February, as we head into the next part of the interest rate cycle in the early part of next year that breaks the market out of any part of the range that we've already seen for the past 2 or 3 months?
Well, I think what you can see, Dom, is, first of all, the PCE inflation numbers, as people are trying to put them together in advance, they're going to show decelerating core inflation. So people are maybe going to be able to gain some comfort that inflation does have some downside momentum, and therefore, the Fed may not have to go as far as they thought, or maybe growth can be more resilient. So I think that every data point is going to be filtered through, this set of expectations that the Fed committee has put out there. And look, we've absorbed a lot. The stock market's in the same place it was when the Fed funds rate was at 0.75% back in the spring. So it's not as if every tick in what the Fed funds rate does immediately takes value out of the market. It's all about how we're getting there and how much longer we have to wait till the end.
And we've just got a couple seconds left. What's the one thing you'd be watching for in the press conference, Mike?
I would say he's going to say we're not done. He's going to talk about higher for longer. And he did say, and see if he actually gives a nod to the CPI data we got yesterday and is willing to exclude the rent calculations from inflation expectations. In other words, to try and say maybe now finally it's time for a more nuanced view of inflation, whereas earlier this year he said we can't do that.
Let's get a quick look at the market as we wait to hear from the Fed chair. The Nasdaq's down about 0.8%, as you can see right now. The Dow less than that, interestingly, down about 0.4%. And crude oil still hanging on to its gains with WTI up about 2.5%. We saw a pop in bond yields, Dom, as well. Immediately after the decision came out, up about 3.5 basis points on the 10-year. And there we still are, sitting right around those levels, around 354.
All right, and what we have right now, you can see right there on your screen, Fed Chair Jay Powell approaching the podium right now, so we'll take you to his comments live right now.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there, far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timoros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions. No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting, you see that you see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability. No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Thank you Mr. Chair, Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing. We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about. This kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of. For cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
That is the Fed Chair, Jay Powell, wrapping up his news conference after hiking interest rates by 0.5 percentage point, 50 basis point. That was what the market expected. And signaling that there's still a ways to go when it comes to interest rate hikes. And he wants to see more evidence that inflation
is coming down in a sustainable way. Look at the market reaction. So we took a dip right when that statement came out around 2:30, and the projections, the SEP he kept referring to, that's the dot plot, came out showing they expect higher inflation, showing that 17 out of 19 of those Fed members expect the peak Fed funds rate to get 5% or higher. That's higher than the market expectations. That's the higher for longer side of the story. The market dropped on that news, but it's come all the way back. At the low of the day, the Dow is down 404 points. We're positive now 3 points. Also want to show you what's happened intraday with the U.S. dollar. This is always the best way to gauge the reaction, the litmus test really for the Fed and for the market reaction. The dollar initially rose. That was the hawkish view that we got on the higher for longer interest rate projections. But then it fell as Powell continued to talk. Falling dollar perhaps helped take stocks up with us. Joining us now is former National Economic Council Director Gary Cohn. He is also the vice chairman now of IBM and the former president of Goldman Sachs. Back with us for his Fed tradition. It's good to have you.
Great to be here, Sarah.
Lot to unpack here. What did the Fed chair just say to you?
So I think we got a little bit of everything from the Fed chair. You know, he came out and he talked about the full effects have not yet been felt. So again, that was a little bit of what we heard last.
The lags.
The lags, the cumulative effects. So we got the cumulative effects statement. And then he talked about the dot plot. And the dot plot, I think, was the one surprising fact that we got here. You know, where you just mentioned 17 out of 19 over 5%, about 5.10. But I remind you, that's 60 basis points away from the 4.5%, which is the top of the range where we're at now. That's one increase at 75 basis points. So we're not that far away. We're at 60 basis points over the top end of the range right now. So we're in striking distance. And then during the conversation, he got asked a couple questions about the restrictive rate. Are we restrictive? He said we are getting into restrictive territory.
Yep.
And that allows me to slow down potentially. Powell talked about potentially 25 basis points in February being on the table, which would make sense. If you're 60 basis points away from your terminal rate, and your terminal rate's sometime in the middle of next year, you know, 25 basis points would clearly be on the table.
So is that your expectation out of this for February, which is the next meeting?
I think today, as I sit here, that would be my expectation. You'd sort of have February and March.
It definitely seemed open to 25 basis points, which is a step down from the 50 we got today.
If you do 25 in February and March, you're at 5%.
Right.
You're basically at your dot plots by the end of Q1 of next year.
But he talked a lot about how, while it was welcome, he used the word welcome to see the inflation rate come down, which we saw in the past 2 months. He mentioned services inflation, which does remain high and climbing. He mentioned wages, which also remain high. And he said the labor market continues to be extremely tight. Why is this a problem for the Fed?
Well, Sarah, I'll point something out here. This cycle started last March. It started 10 months ago. So that's what would be interesting if we get to the end of the first quarter next year. We'd gone a one-year trip. When we started 10 months ago, you and I were sitting here talking about the price of lumber.
Right.
We were talking about the price of gasoline. We were talking about the price of oil. We were talking about the price of shipping containers.
Right.
And
Turns out that was all transitory.
That was what was driving inflation. All of that is gone. In fact, I think oil hit a 52-week low last week. The commodity markets, or the input side of the equation, is basically unchanged year over year at this point. Now, look, we're not feeling that yet in the stores, and we're not feeling that as consumers yet because there's a lag that has to work its way through. But at the spot market today, we're basically back to unchanged input prices.
And there's an increase, and there's evidence that rents are starting to roll over, even though it wasn't in the CPI chart. He mentioned as such,
right.
But he's worried about the historical record suggesting premature loosening of policy while inflation is still high.
So that leaves you with wage inflation. So everything we're seeing is wage driven. I even think that's what you're seeing in the grocery store. If the commodity prices are unchanged, but you're seeing much higher groceries, it's because of all of the wages that are involved in getting those groceries to the store, all of the warehousing, all of the truck drivers, the people in the grocery stores, they're all getting paid more money. So we really have to look at the wage component of the situation. And so we're in this sort of vicious circle, and I think we're at the end of this cycle right now. We're in this cycle, we're in the pandemic. The government initially paid people not to work. The government gave you money to stay home.
That was under the Trump administration.
It was also under the Biden administration. I'll remind you, it was under both administrations. I think you have to be honest and say it was under both administrations. There was a large stimulus package under both. And the government has continued to give you relief, whether it's student loan payment relief or enhanced child care credits. The government has continued to give people stimulus. A lot of that stimulus was pent-up demand. Initially, it was pent-up demand for goods. Then it became wildly pent-up demand for services. And services, people wanted to go travel. They wanted to go see their family. They wanted to go on vacation. They wanted to go out to dinner. They wanted to have a good time. We are starting to see some of that disposable income coming out of the system. We're now starting to see credit build in people's account. We're starting to see default rates build. So we're starting to see a much more normalization. I think we're in this 3-year normalization cycle. If people are getting back to normal, it means they're going to have to go back to work. They can't just go spend money and have a good time. They're going to have to go back to work. If they come back to work and we re-normalize this cycle, that will help us with the wage side of inflation. So I do think we're at this interesting point of inflection here as we get into next year. So the Fed slowing down and the Fed looking at 25 basis point increase will make some sense to me.
Yeah, well, we have to see that labor force participation rate move. Stay with us because we want to bring in senior economics reporter Steve Leisman. He was in the room for Chair Powell's news conference, and Gary and I were talking. We thought you asked a really interesting question about basically whether the Fed chair minded that the stock market is up a lot since the last meeting as he's trying to tighten policy. I'm not sure if you were satisfied with the answer.
Never satisfied with the answer, but very satisfied that both you and Gary thought it was a good question. Look, here's the thing. The stock market, I think, is the least of Powell's problems. I think the bigger problem are the interest rates that I enumerated there earlier. Not to mention, I'm looking right now, Sarah, that the January 24, in other words, the end of the year for next year, is now trading in that 436 area right now, which is, remember, the Fed is at 5.15 for year end. So there's a big gap there. There's going to be some kind of conflict. Let's hear how Powell answered the question about whether or not this loosening of financial conditions represents a problem for him.
I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives.
So he pointed us to the SEP. Let's go to the SEP and let's look at that 2023 outlook there. And you can see right there, 17 folks are above 5%, 5 are at 5.4, and 2 are at 5.63, which, by the way, that goes along there. One of them is out there at 5.63 for a very long time. I'm sorry, that is inaccurate there. It's just 2 at 5.63, not 12. In any event, the issue is that the Fed is, at least in their thinking, much more hawkish than the market. And maybe Gary or maybe you, Sarah, can explain to me how those twain meet.
Well, doesn't usually the market tell the Fed where to go on that front, Gary?
I don't know.
You know, look, it's an interesting debate, but the market's been more right over the recent years or so. I could also point out the obvious. We could look at where the dot plot was a year ago as we sat here, and we could look at where the market was. The dot plot wasn't anywhere close to right a year ago as we sat here. So if you ask me where I think we're going to be, I think the markets looks much more accurate, as I think we're going to get people back into the labor force. People are going to be forced back into the labor force. And we're going to get wages to settle down to some degree.
So, Gary, Gary, you see rate cuts next year?
I'm not sure I see rate cuts at the end of the year.
That's what has to happen for the market to be right.
Rate cuts at the end of the year.
That's what has to happen.
Yep. It's possible that we could get rate cuts at the end of the year. It is possible if we get workforce participation back to where I think we may see it. We'll get participation back, and unfortunately, we'll get participation back at a time when we get jobs slowing down as well, which means we will get higher and higher unemployment, which would then lead you to a rate cut towards the end of the year.
Steve Leisman. Steve, thank you very much. We appreciate it. It sounds like, Gary, you are leaning more into the pause camp.
I guess you would call it a pause. I've always been in the soft landing camp. Soft landing, back
You
to
still see a soft landing, not recession?
You know, I think it's soft landing. There could be a negative
There's a
growth
difference
quarter in
between
there.
a soft landing and a shallow recession, isn't there?
I think we're now in these worlds of technicalities. Yes, there's a big difference between a soft landing and a recession. Absolutely. I do not think we're going into recession. I think what we thought would happen as we renormalize over this 3-year cycle feels to me like it's more and more practically happening. The one piece is people coming back to the labor force. Will we get people back to the labor force? And look, there's always a risk. There's a risk that in the new government omnibus package, we do more government stimulus. There's a risk that we do eliminate student loans and that people take that newfound income and say, look, I can stay out of the labor force longer and longer. I'd like to renormalize as much as we can. And the more that we renormalize and the less that we create stimulus, the more we'll get people back into a normal employment cycle.
So the reaction here is bonds are catching a bid now. So we're reversing the early reaction, and the 10-year is down below 3.5. Stocks, Dow's back lower by 147 points or so. We've been wavering, and the dollar is weaker. Is it ultimately bad for risk, bad for stocks, if the Fed and the market are on different pages about how high rates are going to get?
I think ultimately the Fed is going to get to where the market is. They can only diverge so long. And at the end of the day, the Fed controls the front end, as you and I have talked about. They've got some immediate reaction into some financial impact into the consumer. But at the end of the day, the market's going to control what's going on because corporate debt and other borrowings are going to be driven by where markets price securities.
Can I tell you another very interesting part that I thought that I wrote down was when he got asked by one of the reporters if they would consider revising their inflation target, their goal higher. And he said like 5 different ways, nope, not even thinking about it. It's not something we would consider under no circumstance. And then he said there might be a longer run project about looking at the 2% inflation target. What do we make of that? Because it is going to be hard to get back to 2%, isn't it? They don't expect it till, I don't know, 2025 or whatever the plot says.
Yeah, look, I agree it's a long-run project to get back to 2%. I think it's going to be very difficult for them to get back to 2%. But I also agree with the way the chairman answered it. I don't think in the Powell Fed we will see any deviation off the 2% target rate.
For credibility's sake, he has to stay there.
For credibility's sake. And for the Fed to move their target, that's something they have to take very seriously. They would have to talk about it for a long period of time. They would have to study it. And it's not something they could do very often. If they started moving their targets for inflation around, they would lose credibility very quickly with the market. We're going to adjust our inflation target based on what we see going on in the economy. That would really inhibit the credibility of what the Fed does. The Fed needs to have a stated set of objectives, and they need to live with them through thick and thin.
So ultimately, what it sounds like to me, your reaction, and this is what I think I heard today too, is that he was less hawkish than he was last time, right? A little bit.
Definitely less hawkish than last time.
Yeah.
Definitely less hawkish than last time.
So if he's less hawkish, and they're nearing the end of the hiking, and you think there's a soft landing, do you buy stocks?
Again, overall, I think I do, but I think, as I say many times, I think you have to look at companies and company specifics. I do agree that this sort of spending spree that has been going on for the last couple of years with people having stimulus money and people being able to spend, that's going to come out of the economy. So some companies that have been affected by that are clearly going to have different earnings potential going forward. So I think you have to analyze the companies, to analyze their competitive situation and how they're going to be affected by what I would call a more normalized economic picture in the United States.
There are increasing number of folks in our world, economists, financial market participants, that think that the Fed is oversteering here. Jeremy Siegel, professor of Wharton, hasn't been shy on this network about that. You know, the fact that there's so much tightening done in such a little period of time and that there is a lagged effect. What is that ultimately going to mean for next year? Why don't they just pause now and see how it shakes out?
Well, look, I do believe there's a little bit of truth in that. I've said numerous times that the Fed was late to this game. If you're late to the game, staying longer doesn't necessarily fix the problem. I think they need to take a real, objective view of where we are. Even in the statement, I pointed out that it talks about higher food and energy prices. We do not have higher food and energy prices on the spot market. We do at the retail level. I will clearly say at the retail level.
Food prices went up 0.5% last month.
We do have them at the retail level. We know that we know that rents in big cities are coming down. You have plenty of the big real estate companies on. You have plenty of the big real estate owners on. They tell you that rents are coming down.
Just not New York City.
Yeah, we tell you that rents are coming down. We know that rents a lag in the calculation. So we know that these effects are coming through the economy. So look, I do think in some respects, in the couple of questions where the chairman was asked today, he gave a mild hint that we are slowing down. And we are 60 basis points away from our terminal rate. And we won't meet till February again. And February could be 25. And if we've gone from 75, 50, 25, that to me is a pretty dramatic slowdown.
And then after that, done?
Maybe another 25, maybe not. But by then you will have almost another quarter of data.
Right. And a lot can change.
A lot can change.
All right, Gary, don't go anywhere. Just want to show everybody what's happening. We're taking another leg lower here in the market, down more than 200 points right now on the Dow. The S&P 500 is down about 0.75%. All the sectors just went negative. Consumer staples and healthcare were holding up. They just went down on the day. The worst hit group right now are the financials. The banks are getting hit. The materials, real estate, some of the cyclical groups, again, on this Fed news. Technology is also lower with the NASDAQ down 1%. It's still up about 1.3% so far for the week. Up next, we will get the White House's take on the Fed's decision in a first on CNBC interview with National Economic Council Director Brian Deese. Remember that job?
Yes,
he used
remember
to do
it well.
it. Also, double lines. Jeffrey Gundlach weighing in on the Fed and the impact on the bond market coming up at the top of the hour on Overtime. Stay with us here on CNBC, down 255.
SISI. CNBC.
Welcome back on a Fed day afternoon. Here is what the market reaction is. The S&P 500 is down 0.75%. Nasdaq's falling now 1%. We're starting to move south again. Again, we've been all over the map. The low of the day was down 400 on the Dow right after that. That statement was released by the Federal Reserve. They raised interest rates 50 basis points as expected. But the signal from the statement and the news conference was higher for longer. There's more work to do when it comes to fighting inflation and more evidence that the Fed needs to see that inflation is really coming down meaningfully. But Chair Powell didn't rule out 25 basis points, another step down in the increase in rates at the next February meeting. There's a lot there. The result is we're seeing lower Treasury yield, so bonds are getting a bid. The dollar's a little bit weaker, and stocks are again turning lower. Nasdaq now down more than 1%. Joining us now is the National Economic Council Director, Brian Deese from the White House. It's good to have you, Director Deese. Welcome.
It's good to see you.
So I know we're going to talk about inflation clearly, and I know you want to keep the Fed a little bit separate, but do you sort of wish that the Fed, I don't know, might take a pause as we see inflation numbers coming down and the impact starting to damage the economy?
Well, you're right. I'm going to leave the Fed's decision-making and the communication that they made today alone for the reason that we don't comment directly on their policy. What I would say is if you look at the macroeconomic context over the course of the last couple of months, I think what we're seeing is continued progress and continued resilience toward what the president has been talking about now for months, of this transition toward more stable and steady growth. And I think that that's what we all want to see. And we are seeing some meaningful progress on that front. Resilient consumer, resilient labor market, and now a couple months in a row of inflation showing positive developments in terms of cooling. There's more to do, but certainly we're seeing progress.
Right. And so the Fed chair himself said that there's a lag to monetary policy, as we all know. What are your expectations as a White House economist about what the lagged impacts are going to be on the economy of these higher interest rates?
Well, look, certainly the monetary tightening cycle operates differently across different sectors of the economy. Certainly housing is one place where we have seen a pronounced impact. And one of the things that's interesting about the inflation data that we saw come out yesterday is that we're seeing a sort of a peaking of the printed inflation data on housing at very high levels. But what we know in terms of real-time data in the market is that market rents and housing prices have started to turn over. And so, what you need to do is balance what the data is showing. But what we try to focus on mostly is what's happening out there in the economy. What are people experiencing? What are businesses experiencing? What are households experiencing? And so certainly you got to navigate those lags. They operate differently in different contexts. But, one thing I will say, practically speaking, is that households and businesses over the course of the last 8 weeks, 10 weeks, have been experiencing significant declines in energy costs. That's true at the pump for households, down about $1.70 since the summer. It's also true for businesses. We've seen meaningfully declines in the cost of diesel, for example. And so those are, again, some promising signs, but also things that we know are happening real time in the economy right now.
Where does inflation go next year?
Well, look, we're going to be careful about and cautious about trying to predict the future. There's a lot of uncertainty out there, uncertainty globally, and we need to factor that in. And as the president said yesterday, we have more work to do to see inflation come down. But what I would say is that the signs we are seeing now are promising, promising across goods, promising across services outside of the housing sector. And as I said on housing, there's reason to believe that in the actual market environment, we're seeing progress as well. So I think the outlook right now, I think, is progress and more optimism, cautious optimism that we are seeing movement in the right direction than we would have seen a couple of months ago. But we have a ways to go here. We have to keep our head down. And on the policy side, we need to continue to focus on things that can help to lower costs for American families, lower costs for American businesses. The good news on that front is a number of the provisions that we enacted this summer are slated to start on January 1st. So a couple of weeks from now, we're going to see more progress on the policy front in areas like healthcare and energy.
But you can't deny the fact that the 2023 outlooks are coming out all over Wall Street. for the economy and the markets, and it's marked by declining profit growth, deteriorating profit growth, and economic activity, with many more forecasting recession.
Well, look, I mean, if we were having this conversation early in 2022, there were a lot of people that were forecasting that the second half of this year we were going to see a step back. Now we're operating with we got 2.9% GDP growth last month, and we'll see where we end at the end of this year. We are in a transition, and this transition is operating over the course of the next couple of quarters. I think if you step back, the biggest economic question for the United States is a longer-term question, which is, can we come out of this pandemic cycle, breaking out of the equilibrium we were in prior to this crisis of low growth, low interest rates, low productivity growth, increasing inequality, and really get to a better equilibrium. And the thing that I will say is, talking to business leaders across the board, they recognize the short-term challenges, but almost all of them, to a T, say that they are more optimistic and more interested in investing in the United States over the medium term than they have been in some time. And that's in no small part because of the policy changes we've seen. Long-term incentives to invest in things like semiconductors, a commitment to have more secure, stable supply chains, an opportunity to build out clean energy here in the United States over the long term with incentives to do so. Those are the kinds of things that are actually going to drive the longer term productivity benefits that we need as an economy. So I think there's reason for real confidence in that perspective over the medium term.
Brian, my guest host here for Fed Days is your predecessor. Gary Cohn is with me, who you know pretty well, and I think he wanted to ask you a question.
Hey, Brian, it's great to see you.
Hey, Gary.
Hey, let me change the topic for a minute. I know you must be working around the clock on the omnibus funding bill. Can you give us a little idea and insight on how that's going and where you think we're going to end up?
Well, look, real progress in that the leaders have now announced that there is agreement around a framework. And Gary, as you know, you've been through many of these cycles. The place to start when you're talking about a funding bill is to start with a top line, what's known as how much are you going to invest in the areas of defense and non-defense spending. And there is growing alignment around that. And then what you do is you work down into the details. There are a lot of details that need to get worked out, and then other provisions that may be accommodated in that process. But the good news is that we've got an agreement around a framework, and I think a real durable commitment to try to work to get this done. We have many miles to go here over the course of the next several days. But Gary, as you know and you've lived through, the significance of having a secure, long-term funding of the government so that you're not having to come back in 6-week or 2-month or 3-month increments, create uncertainty across the federal government and everything that it touches is important economically. And so we're committed to doing what we can as administration to help facilitate that kind of outcome. And I think there's some reason for optimism here that we can get that done.
Gary's going to be very nice because he was in that position, you know. So I'll ask the tough question, Brian,
Please.
which is how much stimulus is going to be in there? Are you going to push for the extension of the child tax credit, the student loan forgiveness? And these are factors that matter as we're talking about trying to control the inflation problem in this country.
Oh, look, I don't think this is a stimulus conversation. I think this is about a certainty for government operations and a certainty for the businesses and investors that rely on certain elements of a functional government. So we're talking about, can we actually continue to operate our defense and homeland security functions without having to go in very short increments, the care that we provide for veterans, for education, so people can plan out, particularly important as we deal with the ongoing health challenges that we face. So, look, I think that there is a focus on providing that certainty and stability. That's what folks are talking about. That's what folks are trying to agree on. And I think that ultimately that's the package that we'll end up with. And I'm confident that we can get there.
Don't think that was enough. Brian Deese, thank you very much. Appreciate your time today on the topic du jour, which is, of course, the inflation and the economy on this Fed Day from the White House. Didn't rule out the extra spending that you were worried about.
No,
when it comes to sparking more inflation.
I don't think they will roll it out. I would be somewhat surprised if it's not in the package. It's actually one of my concerns. One of my concerns is the extension of child tax credits. You know, it's a great program, but unfortunately in this period of time, we need to normalize the economy. We need to normalize people back to work. We need to get rid of some of the excessive stimulus programs. You know, I'm worried about student loans. We really need to get people back into the labor force. We can see it. It's the one piece of inflation that we have not been able to tackle. and it's really where we are right now. And hopefully we will normalize this.
And the Fed can't control the labor force participation, ultimately.
We cannot.
Yeah. Gary Cohn, it's so good to have you here, as always.
Sarah, always a pleasure.
Playing a ball with Brian Dees. Up next on the show, Jefferies chief market strategist David Zervos on a Fed day as well on how investors should position their portfolios following the latest rate hike. When we take you inside the market zone, we're off the lows, down 146 or so on the Dow. Be right back. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day, as always. And Mike, the Fed market reaction feels very indecisive to me. We're down, we're up, we're actually climbing again here, down 113 on the Dow. And you've got three sectors that have gone positive in the S&P. They're healthcare, utilities, and staples. So they're the defensive, recessionary type stocks. Which jives with the fact that you're seeing bonds catch a bid. Yields are a little bit below 3.5% on the 10-year, and the dollar is weak. What's your take on the reaction?
It is always a hazard to infer any clear message from the market's reaction to the Fed, and I would say today's S&P moves, for as jerky as they've been, have been entirely within the range of the last 2 days. So there was not some kind of big change in overall outlook. If you look at I think the net change in the committee's outlook for growth for inflation, for where rates go next year, for employment, it all seems like a lower chance of a soft landing. It seems like higher unemployment, slower growth, greater inflation. Even with that, they'll have to have rates higher. Now, the market is not just taking that on face value. The market seems to have greater faith that inflation has downside momentum, and therefore the Fed will either go very slowly toward its target of about 5% on the Fed funds rate, or maybe it won't get there, or maybe it'll cut thereafter. So, you know, in the comments, Powell really did make it clear that it wouldn't be weird for them to step down to 25 basis points in February, and maybe that's all they do for a while.
Let's talk about one part of the market that is certainly very sensitive to these interest rate increases. The home builders, Lennar and Pulte, are outperforming after Barclays upgraded both of those stocks to overweight from equal weight. The analyst there expects interest rates to peak next year, believes Lennar and Pulte are well positioned to benefit from a possible housing market trough. Meanwhile, Lennar is set to report earnings after the bell today. Those stocks are actually up a little bit as we see yields move lower. Diana Olick here to break down the key numbers to watch for, Diana, and of course the commentary will be key.
Oh, absolutely, Sarah. That's all we're looking at, really. Lennar is expected to show an increase in revenues despite the slowdown in home sales, but we'll be watching prices closely and, as you said, any commentary on incentives like buying down the mortgage rate. We heard that recently from Toll Brothers in its latest release. Now, mortgage rates did make a big move during Lennar's Q4, hitting a high of 7.37% in October, but then dropping nearly a full percentage point by the end of November, and that may have helped pull some buyers in the door. But did they sign the contracts is the bigger question, Sarah.
Absolutely. Diana, thank you very much. Let's get more market reaction after that Fed decision. David Zervos joins us, as he does on Fed Days, chief market strategist at Jefferies. So it wasn't the beatdown that the market got, say, in Jackson Hole or in even the last Fed meeting, but there was a message from Powell that there's more work to do on inflation. What's your take?
Well, Sarah, I think the take is that we're coming down in these rate moves. We've gone from 75 to 50. We're nearing the end. There's another 75 left, according to the SEP. And it's very hard for Jay to remain at peak hawkishness, which is really where he's been for most of the year, when you're kind of bringing you're taking your foot off that brake a little bit. So it was very hard for me to see why people would think you could get more hawkish messaging than usual from Jay into a meeting like this, and I think that's really the story. It's a message that is still very consistent with everything he said all year, that they're vigilant. They're not going to make the mistake of the 70s. He referenced that again. You talked about it earlier in your program. So he's not giving you anything dovish to bite on. But, you know, we were already, I think, very close to peak hawkishness. So it just didn't make sense to go in short. And I think the market's kind of telling you that.
So the market's telling you that bonds are getting bought right now. Yields are lower and the 10-year's below 3.5. So we are well off the highs that we were seeing a few months ago. Do you think that's it? Have we seen the highs?
You know, the market is pricing in a lot of credibility for the Fed. A lot of people like to talk about this inversion as the recession indicator, and it is. There's an indicator that we have a risk of recession, and it's a material risk. It's not guaranteed by any means. And some people think we already had one last year with 2 consecutive quarters of negative real growth and didn't feel that bad. But nevertheless, I think the yield curve and the 10-year in particular is really telling you, Sarah, that just the market has an incredible amount of faith in the credibility of the Fed right now, and its desire to anchor long-run inflation expectations, which they've done pretty well in the face of 2 back-to-back 7-handle years on inflation.
So what do you do as an investor now? We've been waiting for progress on inflation. We got that 2 months in a row. Yesterday, it looked like we were going to get a giant rally, and then it basically evaporated, which suggests that there's a lot of hope and optimism already built in around moderating inflation numbers. So what do you do? Are we targeting jobs reports? What sort of signals do you have to wait for to know whether it's a good time to buy?
I mean, honestly, Sarah, I think next year there's just a lot more interesting opportunities, at least from my perspective, in the credit markets than the equity markets. The big difference between this year and last year is not the inflation rate. The inflation rate's exactly the same as it was a year ago. And in fact, the unemployment rate's only 0.2 away from where it was in the beginning of this year at 3.9 down to 3.7. The big difference is that yields are a bunch higher, particularly in the belly of the curve, and spreads are a lot wider. So to me, you've got an opportunity in some of the more beaten up areas of the credit market or leveraging in the higher end of the credit markets that can give you equity-like returns, even double-digit yield returns, without having to take equity risks. And I think that's going to be the interesting trade next year. I'm not sure that the Fed is going to want to see big rallies in the equity market, and they're going to kind of Jackson Hole you every time we rally up, because they can, and they want to get that inflation number down faster. They want their report card to look better. And right now, their report card in the last 2 years has a couple of Fs on it.
And especially now, and there's a little bit of a gap in where the Fed thinks the peak rate is going to be in the market. We've got to leave it there. Out of time, David Zervas, thank you for your initial take from Jefferies. We've got 2 minutes to go in the trading day. Mike, I just want to point out Tesla, if I could, as you go into the internals, because it is hitting a new 52-week low. In fact, lowest level since, what, early 2020?
Yeah.
And also continuing to lag broader market and also the technology.
Yeah, it's both part of a bigger dynamic, which is the unwind of the crowded, expensive kind of favorite growth stocks, but also obviously idiosyncratic with what's going on with Twitter and the loss of faith in shareholders that, in fact, there's leadership at Tesla that's trying to sort things out as demand weakens in China. So you're going back to that very heralded stock split in late 2020 in terms of going through those levels on the, from the upside.
What else do you see in the internals?
Pretty soft. Nothing too dramatic. I mean, the market has really been just kind of twitching within a range here, but definitely more downside volume than upside. Here's the 2-year note yield. This did actually pop higher for a time during Powell's press conference, but then eased back. We're higher on the day, but this has bottomed 3 times this month, right above 4.2. So the market feels as if there's really not a lot of lift, sustainable lift in short-term rates, even if we do get to 5%. The volatility index has come in as would be expected. We passed the big catalyst. We're down below 22 in the stock market. The indexes remain in their range for the week, Sarah.
As we head into the close, boy, what a choppy post-Fed reaction that we've seen in the market. We were higher to start the day, lower on the Fed decision and announcement, interpreted as higher rates for longer, even though we got that 0.5 percentage point increase in rates as expected. And then we've come back a little bit. There's the S&P. It's down 0.5% into the close. Healthcare, the only sector going to go out positive. Banks are the hardest hit, perhaps on those lower yields you are seeing. Weaker dollar as well. The NASDAQ down off the lows, about 0.75%. Apple is a big lag on the NASDAQ. That's it for me on Closing Bell. See you tomorrow, everyone. Into Overtime with Scott.
All right, Sarah, thank you very much, and welcome everybody to Overtime. I'm Scott Wapner. You just heard the bells. We're just getting started from Post 9 here at the New York Stock Exchange with a busy hour ahead. We get right to our talk of the tape. The Fed and your money and what happens to it now. CNBC contributor Josh Brown along in just a bit to answer that very question. But first, let's ask DoubleLine founder, CEO, and Chief Investment Officer Jeffrey Gundlach. He's with us once again in a CNBC exclusive on this Fed Day. Jeffrey, welcome back.
Nice to see you again, Scott.
Yep, it's good to see you as always. I want your reaction first and foremost to this decision, which our own Steve Leisman says was, quote, pretty hawkish for the outlook. How'd you see it?
It started out very hawkish. Jay Powell's first sentences were strongly committed to bringing inflation down to 2% pretty much on a consistent basis. We got more work to do. We anticipate continuing quantitative tightening, reducing our balance sheet as appropriate. And then he, I don't know, 90% of the way through that statement, he repeated those exact same points almost verbatim again. But there was also a balance on the other side, which is reflective of the fact that the Fed realizes that they were way behind the curve. Jay Powell himself said so today, that when we got started, the problem was the pace was important. You'll remember I've somewhat facetiously said that the Fed should raise 200 basis points way back, and I guess it was May. And they basically did. I mean, they did 2.5 bites, I guess. But I think that's what's really important here is the movement on the yield curve, because the Fed now thinks that they're going to have the Fed funds rate at 5.1% or so on the dots. And yet the Fed funds rate is already above the 2-year Treasury yield. And what tends to happen in these Fed sequential or rapid hiking cycles is the 2-year Treasury, as I've talked about many times before, leads the way. The Fed ultimately comes in a little bit reluctantly following the 2-year. And after multiple rate hikes, the 2-year Treasury is all the way long is above the Fed funds rate. They're playing catch up, and then the 2-year Treasury peaks out, and the Fed funds rate keeps going up, and that's exactly what's happening here. So we now have the Fed funds rate above the 2-year Treasury. We have many recessionary indicators, including the leading economic indicators, the PMI for manufacturing, the housing market, of course, lots of these indicators, sentiment, and so forth. And Jay Powell said, I think in a moment of ad-libbing, he brought back the Mr. Magoo kind of thing I talked about earlier this year. We said we're going to feel our way when people were trying to query as to whether they would contemplate a 25 basis point hike. He sort of said, we're going to feel our way. I mean, they're getting pretty close to that 5.1, even if they ultimately make it there, and I don't think they're going to. My intuition is that they're going to be highly encouraged by the inflation data on the headline CPI for the next 6 months. It's going to come down. It's already come down 200 basis points since the middle of the year, and it'll have gone, by the time we get to the May print, we think, that prints in June, we think that the CPI will have gone from a peak of 9.1 a year earlier down to maybe 4.1. And I think the Fed, and that's just because where commodity prices are and where the base effects from last year rolling off some very big monthly numbers. And we now are getting decelerating monthly numbers on the CPI, and I'm having a hard time figuring out why they're supposed to reaccelerate with the Fed funds rate where it is today. So I think that the bond market has completely priced in the fact that inflation is peaking out and going down, and yields are down very substantially. I'm surprised people don't really talk about this. I mean, the long bond yield is down something like 90 basis points. The 10-year Treasury yield is down 75 basis points. And even the 2-year Treasury yield is down 50 basis points. And we're at these levels that suggest that recession is coming. And I think Jay Powell said in many different ways of phrasing it that we're going to be definitely softer. We're going to have unemployment go up to 4.6. And the unemployment rate now is at 3.7. And so the 12-month moving average of the unemployment rate is at 3.9. When that crosses over, and I can't emphasize this enough because employment is a lagging indicator, when that crosses over, when the unemployment rate crosses above its 12-month moving average, you're almost assuredly right at the starting point of noticeable economic weakness. And Jay Powell's clock says that the unemployment rate is going to be at 4.6 at the end of 2023. That'll be well above the 12-month moving average. And most economists corroborate that idea. So I don't think there was a lot new here because we've already kind of peaked out on rates, and the market has been anticipating this rapid increase up to the 2-year Treasury yield, but it's basically already occurred. So I think we're getting late in the game here. And Jay Powell is saying, I'm going to feel my way along. That's that Mr. Magoo driving the jalopy until he hits something. And with the inflation rate likely to go down into the low 4s in just 6 months on a year-over-year headline CPI basis, I'm not sure that he'll call that convincing evidence that we're going to settle in at 2%, but it's a pretty vast improvement from 9.1 to 4.1. And I think that's going to influence the Fed's thinking.
If a week or so ago at the CNBC FA Summit, you told me, quote, I think the Fed is getting it right, it sounds to me like you're questioning that today.
It depends what your definition of right is. I actually think the definition of right is that we raise the unemployment rate and we make more progress, and we aren't afraid of the stock market treading water at best. And we're not afraid of 0.5% real GDP, which sounds to me like an arbitrary number. It sounds a lot like a negative number for 2023 when the Fed itself says 2 years in a row of 0.5. They're not shy. They're admitting the fact that they want the economy to slow down and they want wages to not be rising. One thing weird on wages is Jay Powell said he wants really strong wage increases, but he wants wage increases that are consistent with 2% inflation. Well, what wage growth is consistent with 2% inflation? Sounds to me like it's probably 2%. So I'm not sure that's really strong wage growth, but it'll take some work in terms of unemployment rate going up to get wage growth to be consistent with 2% inflation.
It also sounds to me, as you reference this so-called disconnect between what the Fed is saying and what the market believes will actually happen, it sounds to me today, listening to you, that you think the market is right and the Fed will ultimately have to come to where the market is. Is that correct?
Absolutely. I mean, the price of money, the interest rates are the market. Dots, predictions of maybe what will happen in the future, dots are cheap. You can say anything with dots because you're not committing to anything. So when you say 5.1, I think it's a tip of the hat to, their commitment to getting the inflation rate down, that they're willing to raise that terminal rate. In fact, Jay Powell said it's possible they're going to raise the terminal rate further, perhaps, at the next meeting. Of course, he's not committed to that. I think that's very unlikely when you start to see these inflation trends starting to become much happier. I mean, in the last 2 months, what's really happened is we've had CPI miss on the downside on the monthly number. And that's what's stoked some of these relaxations in the markets with rates going down. And, everyone thought back in September when the S&P was at 3550, everybody and their brother, including me, thought maybe a plausible target was 3,400. Now it feels like everybody thinks the S&P is going to 4,200. That seems to be baked in, or 4,250. That seems to be in just about everybody's consensus case. I doubt we make it that high with this economic situation and with earnings now being meaningfully causing worries about significant declines in the first part of 2023.
In terms of whether the Fed has to come, meet the market, so to speak, and that the market is right, Steve Leisman earlier suggested that in order for that to actually be the case, the Fed would have to cut rates next year, which you actually think they will. At your recent webcast, you said you think the odds are probably greater than 75% that there's a rate cut in 2023. Do you still believe that after listening to the Fed chair today, who you could easily make the case suggested otherwise?
Let's not get too excited about forecasts. I mean, a year ago, the forecast was the Fed might go to 1% this year. And obviously, we're way higher than that. So I just think the economic conditions are going to be such that the Fed is committed. They said in plain English repeatedly now for months that they're going to make this, we're going to get the job done, is one of the emphatic answers that Jay Powell gave. So that means they're going to be hammering the economy, even just keeping rates where they are. And I think they're unlikely to stay on pause in February. So we're looking at another ratchet higher. I just think that's enough. It's the same old thing. We started out with paint or get off the ladder back in February, March of last year. Now I just feel like maybe they're supposed to take a pause. I laugh about that Crown Royal ad where they're taking shots in a bar and the referee walks in, blows a whistle and says, everybody, your next drink is a water. And I feel like we've been doing, metaphorically, a lot of shots here with these Fed funds rates going up. And I think the Fed's starting to realize that want to feel their way, sit back, but the economy's going to weaken. I think that's already happening on many fronts. And that's, at some point, they're going to realize that growth and jobs and other things are more of a concern than they're feeling now balanced against the inflation rate, because the inflation rate is relaxing.
So you're suggesting that you don't think the Fed should do any more hikes at all after today?
I think they should not do any more hikes after today. I've been, as you know, I say this like a mantra, the Fed follows the 2-year Treasury. And the 2-year Treasury is below the Fed funds rate right now as we're speaking, Judge. So I think, they'll probably do another 25. But I thought it was very interesting to kind of feel our way, wait and see attitude. But once that inflation rate dips, and I want to say one more thing that about inflation. The inflation rate forecast is that you're going to get the inflation rate down to about 3% or 2.5% even by the end of next year. And then everybody's forecasts predict that it's going to just stop right there and go dead sideways for the next 3 years, which is completely implausible. The inflation rate never goes dead sideways. Even when it's in something of a range of 100 basis points or so, it's bouncing all around. I just think that with the resolve and the desire to keep rates high, perhaps on an extended basis, that I just think that the inflation rate, if you get it making the progress that's so-called clear and convincing down towards 2 or 2.5%, I don't see any reason why it would stop there. I just think that when we have that kind of momentum, going from 9 down to 2.5, which seems like a stretch it's going to get there, but some people are forecasting that. Why would it just stop there? I think it might actually go down to 0 or something like that. And this is one of the reasons I think bonds are rallying. The bond market knows inflation's coming down. The bond market knows that the Fed has gone a long way and the variables are long, and the effects are long and variable. And we've done a lot of work here, and we don't have a clear accelerant in any sector of the economy. But what sector of the economy is supposed to really keep momentum going? This is why the Fed is basically a 0 GDP forecast. And once that starts to happen, I think you start thinking about easing rates. And when the yield curve's inverted, it's a signal every time that the economy is weakening and the Fed is at the end of the tightening cycle.
It seems as though so many are talking about the degree to which inflation is coming down, except for Jay Powell himself, where he says today, quote, "We've made less progress on inflation than anticipated. Ongoing hikes are appropriate. Continue to see risks to inflation as to the upside." He even used the words himself, tighter for longer. Early in the statement, there was talk about, food prices, energy, things that are obviously coming down. Is he missing something?
He just wants to maintain the inflation fighting credibility that he fought so hard for back in the summer and at the Jackson Hole thing and at some of his past couple of meetings ago. I don't really understand why he says we're not making progress on inflation. He should have said that a year ago. He should have started tightening a year ago, saying we're not making progress on inflation. But there is progress on inflation. It is, sure, some of the core numbers are understandably, because of the construct, are a little bit stickier. But the CPI has fallen year over year 200 basis points. And it's going to fall another 300 basis points in the next 6 months. So I don't really understand why he says that, other than to just redouble his commitment. Just like I said earlier, he starts his statement with, we're going to get inflation to 2%. We're not going to stop. We're going to work until we get the job done. And I think it's a little bit, self-deprecating that he says we're not making progress on inflation at this point, because I saw Gary Cohen on a show earlier. I thought he made a really good point. He said, 8 months ago, we were talking about lumber, right? We were talking about container ship prices. We were talking about all these things, and we were talking about oil, up, and now we have oil near a 52-week low last week. So, I think there has been some progress on inflation. Nobody's really talking about all of these runaway price increases anymore. And with the economy weakening, I think the inflation rate is going to fall faster than most economists do.
Well, you and Gary Cohen are obviously on the same page, because you guys are talking about the same thing, of the market being more right and that the Fed is eventually going to get to where the market is. The other thing we need to discuss are the cumulative effects of all of this, as you have been discussing. In fact, you did in your own webcast this week, where you said the effects of these rate hikes and the accumulation of quantitative tightening and draining of liquidity from the bond market are going to make 2023, in my view, probably a recessionary year. You've told me about this copper-gold ratio, which you use to be a good indicator, maybe the best that you like to look at. But, where Powell says a recession's not set in stone, have you already chiseled it in your stone?
I think it's better than 75% probability. There's two things that people aren't really talking about that really make a difference. No one talks about M2 anymore, money supply, and it's growing at a super slow rate. In fact, the 6-month rate is negative. And I think the year-over-year rate, the 12-month rate, which I think has less significance, but it's interesting, that's down near 0 as well. So there's not a lot of liquidity out there, and making liquidity more difficult, obviously, is the Fed raising rates. But no one also talks about enough quantitative tightening. Jay Powell said 95 billion a month. I mean, this is a lot. This hurts liquidity conditions. It hurts the economy. It makes a headwind for the stock market. I've used for years the chart that shows the size of the Fed's balance sheet overlaid against the level of the S&P 500. And of course, they deviate from time to time. But the broad patterns are very clear to the eye. You don't have to run an R-squared correlation matrix. You just look at it and say, look, when this Fed is shrinking its balance sheet, it gets hard for liquidity conditions, and it's reflected by headwinds for the stock market as well. So that's kind of where we are. So I do think there's a recession coming. We obviously have a housing recession, okay, and we have durable goods that need to retrench. Services, well, people have spent their money on their revenge travel and their services and hospitality. They put it on their credit card. We've had months and months of increasing credit card balances, revolving credit being used increasingly every month sequentially. For months, we had excess savings. Now we don't have excess savings. We have borrowing. So I just think the conditions are very late cycle, and just about everything looks that way except employment, but it's a lagging indicator. And when that unemployment goes above its 12-month moving average, that's sort of recessionary. So what's strong in the economy? It's the labor numbers and more recently, the spending on services. But the spending on services is borrowed money. I just can't find the accelerant to the economy. I guess the one thing you might get, I guess maybe a weaker dollar would potentially contribute to that. But
we're going to talk about that. We'll talk about that as well, and some investing opportunities specifically based on the view that you have. Let's sneak in a quick break, Jeffrey, if we could. When we come back, we'll have much more from the DoubleLine CEO, Jeffrey Gundlach. Josh Brown is going to join us, too. First, our Twitter question of the day. Will stocks be higher or lower by the next Fed decision? You can head to @CNBC Overtime to vote. We'll bring you the results later on in the hour. We're back in just 2 minutes. All right, we're back in overtime. Our exclusive interview with DoubleLine CEO Jeffrey Gundlach continues. The Fed chair was asked about their 2% target, Jeffrey, and I want to get your reaction to a tweet from Bill Ackman a short time ago in which he says, quote, "I don't think the Fed can get inflation back to 2% without a deep job-destroying recession. Even if it gets back to 2%, it won't remain stable there for the long term. Accepting 3+ inflation is a better strategy for a strong economy and job growth over the long term." What's your reaction to that?
I think he's kind kind of channeling on that question that was asked of Jay Powell, maybe are you thinking about raising, your long-term inflation target? And Jay Powell, with no surprise at all, said no chance we're even thinking about that. He'll pass that on to the next chairperson, I think. But I kind of secretly believe that the Fed's inflation target is probably more like 3% right now. I think to get to 2%, this is one of the reasons I say the conditional statement that if we get down to 2, I don't see any way it's going to stop there. It would just be so much momentum to the downside and so much unemployment, as Ackman says, that I just don't know if they really want to go that far. I kind of secretly thought that when they said they want to get into inflation back to 2% back in 2020, I think they really wanted to get to 4. They just don't always articulate the moving of the target because that makes them look weak and makes them look indecisive. But I think the Fed would be very happy if the inflation rate went down to 3% and stayed around there, but they're just not going to acknowledge that. So I think Ackman's probably right on that. And the Fed, I think in this case, isn't being completely transparent.
Interesting. So let's talk about specific investment ideas. Dave Zervos, who was on the prior program, said there are more interesting opportunities in credit than equities. You can get equity-like returns in parts of credit right now without taking on equity risk, certainly looking into the new year. That obviously plays right into your wheelhouse, and knowing you and what you do for a living, I'm sure you would agree with that. But what is the most interesting part of credit right now, if you believe, like he does, that opportunities exist there better than they do in the stock market?
Yeah, first of all, I do agree with Zervos on that, and I've been talking about that exact point for the past couple of months, that you had incredibly different opportunity set in the fixed income market today than where you had a year ago. A year ago in fixed income, to get 5% yield, you had to leverage junk bonds and hope you didn't get any defaults because their yields were around 3.5. You had to leverage them almost 50% to get there. And roll forward to a couple of months ago, and there were double-digit yields all over the place in the bond market, and you had already had a 50% drawdown on the long-term treasury. And those things happened simultaneously. So interest rates went up, making bonds more attractive. Of course, inflation went up too, so you have to factor that in. But yields went up and the spreads on credit product widened in some cases pretty dramatically, for example, in emerging markets. And so I started to advocate at that time a mix of long-term treasuries together with some of these exposed credit sectors. So double B corporates, single B corporates, some sort of structured products, some commercial mortgage-backed securities. When you say things like commercial mortgage-backed securities or consumer receivable asset-backed securities, people immediately, break out in hives. They say, oh, but that's the area of the economy that could be stressed during the recession. Of course it is. That's why they're cheap. Things get cheap when there are obvious risks. Where you have problems in fixed income is when there are risks, but you don't see them or they aren't being contemplated. Now, some of that strategy that I advocated has worked pretty well. I mean, already, treasuries, long treasuries are up, 12% or so since then because the rates are down significantly. And the credit market spreads have come in as well, leading to some like 8, 10, even 12% returns in just 2 months out of fixed income. So the super low-hanging fruit isn't there anymore, but I still think it's a top quartile type of attractiveness, particularly versus stocks. You facetiously, Scott, said that knowing what I do for a living, I'm going to, of course, say bonds have opportunities on a risk-adjusted basis, but it's not true that I always say that. In January of this year, I talked about how overvalued the S&P was on a valuation basis versus its own history of like PE ratios and stuff. But I said at that time, they were very cheap to bonds, because the yield on bonds was so ridiculously low entering this year that as overvalued stocks were versus their own history, bonds were even richer. Well, that's completely changed. So you've gone now to a situation where you can get an income stream from a mix of long treasuries, which protects you from the recession, so it allows you to own some of these credits. You can easily put together an 8% yielding portfolio, which is fairly balanced in terms of its risk. It's gone up in price in 2 months, so it's not as attractive as it was. But that's about 4 times the income stream off of stocks. And you're buying bonds now because the prices are down so much. I mentioned that the 30-year Treasury had a 50% drawdown. It's now more like 40%. Still, it's a big drawdown. So you can put things together. And when you buy bonds at prices of 50 or 60 or 70, you have tremendous upside because bonds have this natural ability to go back to par. If they're going to pay back, they're going to go back to par. And so you have tremendous upside opportunities while having 4 times the income flow. And I have to believe that if the credit part of the portfolio does badly because of recessionary risk, I think it'll be offset by treasuries. But I also think that stocks will go down more than this bond kind of concept, mixing treasuries with sort of single B, double B opportunities in the credit market. And I would also add emerging markets at this point in time. I think fundamentally we still think they're challenged, but I like the fact that the dollar has peaked out. And that peak is getting quite convincing. And we're starting to see foreign stocks doing better than U.S. stocks in recent weeks. And we're starting to see emerging markets put up some pretty big numbers, but they fell so far. I mean, they were down like 30%, and they put up a month in November of something like 7%, but still, that dollar trend is very critical to investment allocation. I've been talking to you for 2 years probably about the time will come when emerging markets are effective. I think that emerging market debt should be part of that mix. That should be part of the credit piece of the barbell portfolio of long-term treasuries and these credit opportunities. I think it outperforms stocks on a risk-adjusted basis. I think your worst case really is a mix like this does about the same as equities. I think that's probably your worst case.
Interesting. No, I just figured I was giving you the ball right at the rim, sort of asking the so-called bond king about whether he thought there were better opportunities in credit than equities. That's all. Hey, Josh Brown is here with me on the set, Jeffrey, and he'd like to ask you a question as well.
Hey, Jeff, thanks for being with us tonight. Really appreciate it. Nice to see you. I wanted to ask you about international stocks as an allocation. Over the last 3 months, we've seen MSCI EFA up about 11%, the S&P flat. Very surprising. We don't see that often. A lot of that is probably the unwind of the dollar rally. Do you think that sort of thing might have legs? And do you think that's kind of an extension of the value versus growth rotation? Should we not get too excited about that, or could it be a sign of something bigger? Because for the last 10 years, EFA has lost again and again and again versus SPY. It would be really interesting if we get a prolonged stretch where that trend goes in the other direction. What do you think?
I think the growth value thing has reversed from the 2020 extreme a pretty large amount. And so that reversal seems to be more complete than the one on non-US stocks, in particular emerging market stocks. European stocks, if you hedge out the currency, which would have been pretty important over the last 2 years, have actually outperformed the S&P 500 moderately. But emerging markets are very cheap, and the dollar unwinding is clearly essential to emerging markets reversal, as you correctly referenced. And I think the dollar reversal has tremendous legs. I think it has legs because the Fed is incrementally going to be more dovish than other central banks. They're going to be more dovish than they think, quite frankly. So I think that's there. And the budget deficit in the United States is going to be going up again, not only because of the losses at the Fed now and the interest rates the Fed is paying on Fed funds rates and stuff like this are higher than the balance sheet portfolio. So that's going to be contributing to the deficit. The Fed used to be sending money to the Treasury Department. Now they can't send money to the Treasury Department. And of course, the recession will be a deficit problem. And the deficit situation is going to be a real issue in the next recession. And I think that's going to be weigh pretty heavily on the dollar. The dollar, you're absolutely right, Josh. The international stocks lost over and over and over again. And we got to this place where the U.S. stock market was supported tremendously on free money and speculation. I think I would actually just look at Bitcoin to underscore how much speculation is behind the price movements and how much speculation was behind the stock market, Bitcoin, and everything else in response to all the government money. I wish the government would stop stimulus just outright. And as Gary Cohen pointed out, they're not really there yet. I wish they would be. It would make Jay Powell's job a lot easier. But I think I would advocate non-U.S. stocks. I bought some European stocks a couple of years ago. They haven't hurt me at all. They haven't really helped very much. But I think if you're looking for asset allocation for a real investor, I'm not talking about for the year 2023. I'm talking about for a 5-year horizon, maybe even a 10-year horizon. I think you want to own these emerging market equities. Their Shiller-Cape ratio is less than half that of the S&P 500, and it looks to me like the dollar's peaked and the emerging market trend is reversing versus U.S. equities. I would not invest in China, however, as a dollar-based investor. I think there's too much geopolitical problems there, and you could win but not be able to cash the ticket, if you know what I mean. They might just cap. They might, if the investment loses, you're holding the bag. If the investment wins, they're going to take it away from you.
We'll make that the last word. Jeffrey, thank you very much. Wish you a great end of the year. Happy holidays. January 10th is your big webcast, so we'll be listening in there, and we will look forward to spending the next Fed Day with you among all those that lie ahead. Thank you.
All right. Thanks, Judge. Big Bills game coming up this weekend. I'm hoping for a big W there. Good to see you, Judge.
I know you are. All right, you as well. Be well. Yep. That's Jeffrey Gundlach of Double Line joining us in yet another CNBC exclusive interview. It's time now for a CNBC News update. Josh is going to be back with us, of course, in a little bit, too. But Frank Collins here now with the news. Frank.
Hey there, Scott. Here's what's happening at this hour. More tornadoes from a massive storm ripping across the U.S. In southern Louisiana. 2 funnel clouds were seen merging as a nearby hospital was damaged earlier in the day. Police blamed another tornado for the death of a mother and her son. The 8-year-old was found a half a mile from where their home was destroyed. Across northern parts of the Great Plains, crews are busy clearing inches of snow from busy roads. Parts of South Dakota were hit with more than 2 feet of snow. The storm is expected to bring harsh conditions to the eastern U.S. in the coming days. And an investigation has found widespread misconduct directed at the players of the National Women's Soccer League. The probe was commissioned by the league and its players' union. The report details emotional abuse and sexual misconduct involving multiple teams. And it also found instances of sexual abuse and manipulation. The league's commissioner has apologized for systemic failures in protecting players. That's the very latest. Scott, back over to you.
Oh, I appreciate that, Frank. That's Frank Holland. Thank you very much. Up next, much more on today's market action as the Fed signals more rate hikes are ahead. We'll break down what it all means for your money next in Overtime.
banking app.
We're back in overtime. Stocks pulling back as the Fed raises rates by a half point, signals even more rate hikes are ahead. CNBC contributor Josh Brown, Ritholtz Wealth Management, as you know, was here for our conversation with Jeffrey Gundlach. So you heard what he had to say.
Yes.
And it's good to have you here to react to this. Headlines from him: Fed should do nothing more.
Yeah.
Stop now. And that we're going to have a recession, that there's a 75% chance. What do you make of what he said and what you heard from the Fed?
So that camp has been growing, and we hear that again and again. And it's not people predicting the worst recession ever, because the one thing that you continue to hear is either rolling recession, meaning different industries experiencing it at different times, which I would argue we're in the midst of. Go tell somebody in the mortgage business we're not in a recession, they'll laugh in your face. So I totally agree with that idea. The other idea is mild recession and then mild recovery, because the tug of war of the largest forces that would influence that outcome is going to be one for the ages. Now you're in a situation where no matter what you do, the hurdle rate is going to be 5%. Do I buy this stock? Do I buy this fund? Do I want international stocks? Do I want large cap? Okay, will it do better than 5%? Sleep at night, absolutely no volatility, no risk. How many investments can you really say that about? So very oddly, the meme that's taken the market is, I want slow growth, reliable, high quality, dividend, high cash flow. I don't care about growth. I don't care. I'm not so sure that's going to be the case throughout 2023, because one of the things about markets where economic growth is tough to come by, the companies that do have a secular growth story actually tend to capture our imagination. And you're going to see some growth stories that don't require the Fed to be, quote, on our side. So I think it's going to be a little bit trickier than just buy the most conservative stocks, you'll be fine. That's what's worked in Q3 and now in Q4. I don't know that that's definitely the case next year.
What sectors are you thinking about will do better than others in the environment in which you describe a mild recession, mild recovery, muted stock returns?
Healthcare. If you are involved in names where they have a secular growth story that is not reliant on the Fed turning dovish or GDP growth beating expectations or any of the things that are probably going to be tough to come by in the first half, those are the types of stocks that other people are going to discover after you and pay higher prices for, because, again, growth will be scarce, and in the end, everyone's got to allocate somewhere. So, look, tell me, if you have an investment story you want to tell me why that is materially better than buying the BIL ETF at a 4% yield and not worrying at all about volatility. It's a tougher game to play than the game that we've been playing since 2012.
What do you make also of what Jeffrey said in the response to your question about international stocks versus U.S.?
I think it's interesting. You have high yields. You have companies that if you look at the European indices, for example, what are they overweight in? They're overweight in all the right sectors that are working in the U.S. They're overweight banks. They're overweight mining, believe it or not. They're overweight energy relative to what we are in our indices. So it's not necessarily all a dollar differential or interest rate differential story. Some of this is about literally industry group concentration in those indices. If I told you how well the FTSE was doing, you wouldn't believe me. It's shocking. Because
the narrative is the recession in Europe is going to be longer and much deeper than it is if we even have one here.
Look, the years where Europe does great and the U.S. is struggling are few and far between. I actually can't even think of one. However, if you've got this continued value trade in favor and the industries I just explained, if those continue to remain in favor, there's a very good argument why EFA could outpace the United States. And by the way, you're paying a much lower valuation to find out.
We're looking at the chart right there. Let's expand our conversation, bring in Mira Pandit, global market strategist at JP Morgan Asset Management. Welcome. It's nice to see you here today. So what's your reaction to what you got out of the Fed, and what's your investment idea given what you saw and heard?
Well, it was a surprise to see that terminal rate moved up to 5.1% as a potential for next year. But yeah, the bigger surprise to me was the distribution of the dots when we take a look at the dot plot. Because if you look back in September, 0 members of the FOMC thought the federal funds rate terminal rate would go above 5%.
Now you got 17 of 19.
Now you have 17 of 19. Not only that, but if you look at that dot plot more carefully, 7 people also said above 5.25. So it's clear that this debate over the terminal rate is going to continue into into next year, which means that we're going to continue to see volatility in both stocks and in yields. Right now, I do think in the short term, yields need to reprice a little bit more, 3.5% or less on the 10-year, 4.2% on the 2-year. It doesn't really reflect an environment in which the Fed funds rate is near 5%. But at the same time, if we do end up in a recession at some point next year, which I do believe we will, very likely, then that is an environment in which yields can then come down more substantially. So I do think that legging into a bit of duration, higher quality bonds is one that will help protect portfolios in the new year.
You're referencing this disconnect, we want to use that word, between the Fed and the market. You heard Gundlach and many others suggesting, including Gary Cohn, who was on prior to us, saying that the market is right. The market's going to be right, and the Fed's going to come back to the market. If that is, in fact, the case, what does that mean for equities?
I think the Fed's biggest fear at this point is not moving from 7% inflation to 4% inflation, but it's what happens when we get to 4 and how quickly can we get below that, closer to their target. So I think the Fed has to talk tough in the interim to make sure that inflation expectations continue to stay well anchored and potentially move lower. And they need to convince the market that they are going to be tough on inflation and prevent any sort of drift back higher, that they're going to continue to be very persistent and resolute. So I'm not surprised to necessarily see them want to gear towards hawkish. Fool me once, we saw them be quite hawkish in Jackson Hole in their November meeting. We didn't really see that at the Brookings meeting, and I think that therefore we were primed to see a pushback on financial conditions this time around. But I do think that when we think about the markets next year, look, if the Fed doesn't come in as strong as they say they are today, maybe that could provide a little bit of a relief rally, but we're still going to be very restrictive on rates, and that's still going to be a headwind for the equity market next year.
One of the things that we really benefited from is that everyone was able to refinance and refinance over the last couple of years, and we really just don't have this economic slowdown being accompanied by blown up balance sheets, massive bankruptcy. In fact, most of the high yield issuers are energy companies, and arguably they look better than they have in any previous recession. But you do have a wall of maturities, probably the end of 23 going into 24, where all of a sudden that could become a fear if we're actually in recession. How do you guys express that idea to clients about, yeah, everything looks calm now in corporate credit, but it's not going to go on like this forever? Like, how does that work?
If you're allocating to credit right now, you certainly want to be in the higher quality areas in that investment grade space, not in the high yield space. We've actually seen that high yield spreads have tightened for the last 8 to 10 weeks, and we would expect them to widen quite considerably in a recessionary environment. Even if we look at spreads, during non-recessionary times, we're about 58% of that peak in the high yield market. So we really need to see spreads widen quite a bit from here in order to get comfortable with pricing, to feel comfortable with that risk-reward trade-off. So right now, we would certainly gear more towards the investment grade over the high yield, again, really leaning into that quality. I do take your point, though, that some of the fundamentals in the high yield market look better. It will become attractive, but right now we don't want to get too greedy with yields.
You know the saying goes, don't fight the Fed. And I'm wondering if that's about to turn. If you do believe, like Gundlach and Cohn and others are suggesting, that the market is going to be right, at some point, is it going to be right to actually fight the Fed and figure that they're not going to be able to do what they say, that they're not only going to pause, they're going to be forced to pivot? And at some point, and I don't know when that date is, that it's going to be more prudent to fight the Fed rather than not.
Well, what we know about how markets move is they tend to bottom in advance of a recession, in advance of earnings bottoming. So if we're starting to see some of that looming as a result of some of the Fed's actions, we don't want to reposition portfolios too late. In fact, if you want to be a little bit more defensive, a little bit more cautious, the time to do it would have been this year, and kind of stick with that plan into next year. But we could also be in a position where you tend to not see multiples and earnings both decline in a given year. So next year could be the year where earnings decline, but multiples actually start to pick up, because markets are forward-looking, looking beyond what some of this action could entail. And I do think while the Fed has pushed back a lot on we're not going to cut rates in 2023, if we are in a position where inflation is closer to 3% and where growth has slowed down and we're actually in recession at the end of 2023, it's going to be a little bit hard for the Fed to keep rates above 5%.
Right.
Even if they go to 4.5%, 4%, you're still pretty restrictive in that environment. So I do think that the Fed is forecasting a little bit differently than they may eventually act, given how quickly inflation probably is going to come down. You know, we see inflation kind of shaped like the Eiffel Tower, rises very sharply, falls very sharply. So I think the path from 7% to 4% on inflation is one that we could see and reach quite swiftly by, I agree with Jeff Gundlach, probably the summer. The question is, and I think what keeps the Fed up at night, is how do we get from 4% closer to the Fed's 2% target, and is that 2% target achievable without a recession?
And to his point, whether you just blow right through that, why would you stop even if you get to 2%? But we're going to see how it all shakes out. It's great having you here. Thank you so much, Mira. Josh, thank you as well for being here, sticking around, too. We'll see both of you soon. Up next, we're breaking down the biggest stock moves in overtime. And later, Santoli is here with his last word, reaction, of course, to the Fed. Our interview with Jeffrey Gundlach. We're right back.
Not a catch in sight.
All right, let's track the biggest movers in overtime now. Christina Partsenevelos, of course, is here with that. Christina?
Let's start with shares of Warner Brothers Discovery. C-sign right now in the OT after the company said it expects to take a bigger write-off than initially expected as part of the company's restructuring following the merger with Discovery. In a filing, Warner Brothers Discovery says it will need to write off an additional $800 million in content and development costs. The company says overall restructuring costs will now be between $4.1 and $5.3 billion. The shares are off about 0.5% right now. Shares of Novavax right now, though, that's another story, down over 11%, double digits after announcing it will sell $125 million of its common stock, along with an offering of convertible senior notes. So this is unsecured debt securities that are purchased by institutional investors. The company says the proceeds from these sales will go towards paying down debt, clinical trials, and other corporate stuff. Last but not least, another common stock offering, sending shares of New Fortress Energy lower in the OT. The company saying it is selling nearly 7 million shares, about 3.3% of its outstanding float. The liquefied natural gas firm said the company itself is not selling any shares. A little bit of a different story there compared to Novavax. Shares are down over 4% for Fortress Energy. Scott.
All right, thanks so much. Christina Partsenevelos still ahead. Santoli's last word when we come back.
banking app.
Last call to weigh in on our Twitter question. We want to know, will stocks be higher or lower by the next Fed decision? Head to @CNBC Overtime to vote. The results plus Santoli's last word is next.
On Peacock.
The results of our Twitter question are in. We asked, will stocks be higher or lower by the next Fed decision? Slim margin, the majority of you saying lower, but it was a pretty close race until the end. Let's get to Mike Santoli for his last word. What do you make of everything today?
Everything, well, everyone talking about the apparent divergence between how the market is looking into next year and how the Fed is saying next year is going to play. This supposed disconnect. And there is one, obviously. But what the market knows is it's 7 weeks till the next Fed meeting. It's a pretty long stretch. It's early February. The average time between the final hike in a Fed tightening cycle and the first cut is 5 months. Okay, it's not because the Fed a year in advance said, well, we're going to finish tightening here and then we're going to start to cut. It's because the cycle happens. So the market is pretty much pinning its hopes and expectations on downside momentum and inflation enough so that the Fed doesn't have to make good on its promise to be hawkish continuously to get rates above 5%. So that to me explains it. And, you know, for months and months, I've been saying, everyone's been saying, Powell's going to talk hawkish until the moment that kind of he has no choice but to not be, or the data get better. Well, it's all about the inflation numbers. It's not about what they think the neutral rate is, whether we're restrictive yet. It's about what the numbers tell us.
The question is, does something break in the interim?
That's right. Yeah. And does the economy, and are they going to be correct?
That's what I mean about breaking.
It's going to take 1.5 million job losses and get unemployment up to 4.5% before we can get traction to the downside on inflation. Yeah, that's why it's a tricky environment, but not necessarily one that the Fed is going to force the economy into anything or not. If we get lucky on inflation, the way we got unlucky on inflation all 2022, then it's a more benign story.
We'll have to be talking about, you know, the chances of a recession now, a chance of the Fed making a major error. We'll see. I'll talk to you tomorrow. That's Mike Santoli. His last word. Fast Money is now.
Right now in Fast, the Fed hiking interest rates to their highest level in 15 years. Chair Powell telling the markets rates will be higher for longer. So does this mean growth will be lower for longer? Plus, Tesla's unlucky 13. The stock now down nearly 13% this week and over 55% this year. Still, retail investors, they keep piling in. We'll go inside the numbers. And later, a shark on the hill. Shark Tank's Kevin O'Leary testifying before the Senate on the collapse of FTX. He will join us to detail what he thinks led to the collapse of SBF's empire. And we'll ask him how he and so many investors got duped in what the new CEO called a straight-up embezzlement scam. I'm Melissa Lee. This is Fast Money live at the NASDAQ market site. On the desk tonight, Tim Seymour, Karen Feinerman, Guy Adami, and Michael Contopoulos of Richard Bernstein Advisors. And we start off with a volatile market reaction to the Fed's latest policy move. Major indices ending a two-day win streak after Fed Chair Jerome Powell dashed hopes that a pivot was imminent and suggested the central bank would keep raising rates through next year. The Dow dropping more than 400 points at its low. The NASDAQ falling as much as 1.7%. The moves coming as the Fed now sees rates topping out at 5.1% next year versus their previous projection of 4.6%. It also cut its forecast for economic growth and raised the outlook for unemployment. So what does the prospect of higher rates for longer mean for the markets? Guy, what do you say?
I'm shocked the market's not lower than it is.
Yes.
I mean, we traded from 34.90 to basically 4,100. We're either side of 4,000 here. Again, we play that game. If you had told me a week ago this is what he would said, this is where the market is, I would have said the S&P's down 150 handles easy given the run. It was down, what, 25? That's not bad. Now, listen, obviously tomorrow's another day, we'll see. But he was crystal clear. We're missing, and we're missing by a lot. The labor market's still too tight. I mean, he could have been more clear in terms of what their expectations are and what they're going to do all of next year. I'm shocked that the market didn't behave in kind.
Michael, what was your take?
Yeah, I agree with Guy. You know, I think Steve Leisman opened up the press conference asking about financial conditions. And to me, you know, Chair Powell sounded quite hawkish. You know, he was saying basically, listen, guys, you know, we're going to be higher than you expect. We're going to be higher for longer than you expect. Invest at your own peril. You know, the Steve, I think, asked specifically about the November meeting to the December meeting and the rally in equities, lower yields. And Powell said, listen, you know, we don't care about intermeeting moves. We care about a longer term horizon. And the market just didn't get it.
Yeah. Sandy Canold, our executive
Top
producer, and I were chatting while the press conference was still going on, and I said it feels like the market should sell off into the close. Like everything was out there for the markets to be like, oh, much more hawkish or more hawkish, and so therefore we need to sort of correct for that. And yet that didn't happen. Why do you think?
I think it didn't happen because people are expecting that the inflation data will be better.
And so
that
will force the Fed to...
That will give the Fed some cover to not be quite as aggressive as he sounded, because he did sound pretty aggressive.
Yeah.
And you had the plot with the 5.6 number out there, 5.63 at the high end, which is, you know, I don't know who that was, but it was the idea of, you know, they have said for a long time, we want positive real rates. And with inflation here, you got a ways to go to get so it was very, very hawkish. But that's my only explanation, that people think that inflation's really rolling over, and that will give them some hope.
Well, and look at the VIX that was down almost 7% today. Would you have expected this on a Fed day? But, you know, that VIX tells you there was a message of relief. And I think the message of relief is that people kind of, they have a sense of what they need from the Fed. Look, Powell was very clear, and Michael emphasized a couple of the most important. It's about the labor market right now. And he said market conditions are extremely tight. We're in a place here where we're very focused on that, and we're going to remain higher for longer. Ultimately, for equities, the problem and you know, the benefit here of this is that lower growth for longer is certainly not great, but it's not a credit crisis. It's great we have a credit expert on the desk tonight, because ultimately I think markets were preparing for the next leg of the journey. We've priced in the Fed. I mean, the Fed was 34.50 on the S&P 2 months ago. That's where we are. We're waiting for earnings to be revised downward, but really the thing we're most concerned about is a credit crisis. When I hear Powell reiterate, and he doesn't have a crystal ball, but he's sticking by, hey, I'm not sure we have to have a recession. recession. That's an environment where stocks, I think, are going to be under control here, especially when people are underallocated. There's ways to invest through this. You're buying, high quality stocks, free cash flow generators, companies that are paying down debt. There is a playbook for that.
Right. Majority of dots say above 5% for 2023. And so while there may not be a credit crisis, couldn't things get a little dicey? I mean, if rates stay higher for longer, debt payments, interest expense will expand. I mean, at some point, that's going to catch up.
That's absolutely right. And I mean, if you look at lending standards at the moment, they're the tightest they've been since the global financial crisis. And that's only going to get worse, right? What I think that investors don't quite get yet is that the move from 7.1% to 5% is going to be pretty easy. The move going from 5% to 2% is going to be very hard. In order to get that last leg of inflation lower, the Fed's going to have to stay restrictive, which they already are for much longer. Now, I'm like Tim, I don't think a credit crisis is looming, but we're going to see wider spreads, and we're going to see a much more difficult credit environment as we go into next year. It's not a crisis. It's not the type of leverage you had during the GFC. But it's also not going to be, all roses either.
Effectively, we need unemployment to go up significantly from where it is now in order for them to take their collective foot off the gas. So think about it. You're talking probably a 5 handle or so on unemployment is my sense is what their bogey is. What does the country look? What does the economy look like under those scenarios? What does the consumer look like? What does growth look like, and what do earnings look like? So we can say the Fed has your back, doesn't have your back, but at the end of this, and Tim mentioned it on Twitter the other day, it comes down to earnings, revenue growth, and earnings growth, and we just don't have it, in my opinion, to necessitate or to have this multiple of now probably close to 19 times next year's numbers make any sense to me. It doesn't make a lot of sense.
So the reset will happen in, higher rates, and we're going to talk about this more in depth later, but what we saw today was the growth stocks came off. We saw a move into defensive for sure, Tim.
Yeah.
Is that the playbook then?
I think the playbook is, look, I expect small caps to underperform large caps. I expect quality to outperform. I expect companies that are generating free cash flow. And we've talked about some companies that, we heard from Delta today. They had an investor day. I know airlines aren't sexy, and I know, I've probably talked about Delta for a year and been largely wrong because the stock's only started to move now. But this is a company that's going to double free cash flow next year. This is a company, you look at the energy sector. Part of the story is I don't invest in the price of oil. I invest in energy stocks and energy companies. They're paying down debt. Their debt to EBITDA levels. We're going to talk to Paul Solanke later in the show, so I'll save that conversation. I just think you've got a backdrop here where there are ways to invest through this. I think the most interesting place maybe is banks, right? I mean, because if you take credit off the table, banks have great balance sheets, at least for now. They are paying dividends. They are generating free cash flow, net interest margins in a higher rate environment. This is what banks have been waiting for. Look at European banks. They've been outperforming everything because you went from the worst negative real rates in the world by far to a place where these banks can be profitable in their core business.
Yeah, Karen.
Yeah, I think that's an excellent point. If we see the Fed stabilize and rates are higher, but they're not really moving that much, that's sort of an okay position to be in. And right. And if they can get deals done, you would know better than I, but if the credit markets are thriving at just the new normal, right? That's a good position for banks as long as credit, the underlying credit worthiness is pretty good.
And that's one of the things that we're seeing, though, is that banks are having a hard time offloading risky debt, right? Yeah. You're seeing hung bridge loans. Right. You're seeing the demand for risky credit at virtually nil at the moment. I mean, CCC issuance has been zero for the last several months, and the banks are saddled with debt. So I'm a little bit more cautious on the banks. Higher rates do help. But remember, what NIM is going to follow, net interest margin, is the steepness of the yield curve. And an inverted yield curve is not good for banks.
But wait. Yeah. Can I just address that, though? The banks do seem to trade on this 2-year, 10-year, right? However, that's not the way they're set up. That's not the way the net interest margin works. Their duration is nowhere near that.
But isn't that a function of the fact that deposit rates haven't gone up yet? And all it just takes is several banks to bring up deposit rates, and you start killing that net interest margin.
Definitely there's a lag, and that will, but right now, if you look at the short end of the curve, I mean, that's a huge spread for them.
For now.
Yeah.
For now.
So, which leads me to this question in terms of the yield curve.
Show.
It is? Oh, it is. 3.47% thereabouts. That's where we are at the 10-year yield. What does that tell us?
Headed lower, I think.
Yeah.
I think it's, again.
But what does that tell us?
Tells us growth is slowing.
Okay.
And then the front end at 4.25, probably staying there for the foreseeable future, tells us inflation's still a problem. That's not a healthy scenario. And again, my opinion, Steve might have some thoughts on this for the equity markets. It's done well so far, but it's an negative 80 basis point inversion, I think headed to 1%. I don't think that's a particularly healthy scenario.
Let's bring in Steve.
Bring him in.
Aforementioned.
Yes, the aforementioned Steve. CNBC senior economics reporter Steve Leisman. Steve, I'll ask you that question. You were sitting, you opened up the press conference with Chair Powell. What does 3.477% on the 10-year yield tell you? The fact that yields went lower today.
I don't know what to believe anymore, Melissa. I am betwixt and between. I'm about to have a intellectual crisis right here on national television. I have a Fed chair and a really committed Federal Reserve to raising rates above 5%. And I have a market, for lack of a better word, showing the Fed the finger, essentially, here. And you can see it. Can I say that on national television? I don't even know.
You just did, sir.
I just did.
You just did.
But I didn't say the word, so maybe that's okay.
It's fine.
It was all right. It's fine. So anyway, the point being that when you look at, guys, if you could put up that Fed rate outlook chart, look at where the market is for next year. That gap is now growing, is now grown today from where the Fed thinks it's going to be and where the market thinks you're going to be. So what is that? 65 and 15. That's 80 basis points right now between where the market thinks the Fed's going to be end of the year and where the Fed thinks it's going to be. And if you're going to ask me, who do you believe? I don't know. I don't know. The market has a view. And I got to say, the only way to square this, the market view, is that inflation comes down, and it comes down hard and fast and convincingly. If that is the case, the market will be right and the Fed will be wrong. I think there's less consequence to the Fed being wrong than the market being wrong, because if the market's wrong and inflation stays high and the Fed has to go up to 5 and change, I think there's some adjustment in some of your guys' portfolios over there that needs to be done.
Yeah. I mean, if inflation comes down very swiftly, which would be a great thing, there's still a lot of tightening, the lag effect that's going to happen, and there's the QT effect that's yet to happen. And so,
that's right.
I think that people on this desk might posit that 3.477 is telling you that the Fed has overstepped or will be in a position where it has overstepped, because inflation will come down.
Inflation will come down.
And all this tightening is already in the pipe.
Yeah, and the economy will slow more than the Fed forecast. Yeah. I have to say, Melissa, in all honesty, I didn't know the answer to the question that I asked Powell. I don't know what he can do here. And I think his answer was sort of, what's the way you say it, sort of a play within a play. All he could do was talk tough and say, look, we may raise it again. We're going to go up to 5 and change. And if you look, by the way, at the conviction of the Federal Reserve, I was very impressed by this. I broke down the dot plots for you here. Take a look at how the 2023 projections they have here. 17 members are above 5% now in terms of the outlook for the Fed. None were in the last forecast. Well, there's that way to look at it. Guys, I gave you a better chart that's more understandable. But in any event, maybe you can glean from the dots. There you go. I think that's an easy way to understand it. 17 are to the right of that 5.13. And there's a good wing there. 7 are above 540. And as Karen was saying earlier, there's one person who's not only 563 for 2023, but 2024 and 2025. That one person, we don't know who that is. We're going to try to figure that out, of course, over time. Only 2 are, look at that rate right there at 490. That's where everybody kind of thought the Fed was going to. So there is conviction on the Federal Reserve of getting up to that level and staying there. By the way, that's the year-end forecast. That's not the peak rate forecast. That's the year-end forecast. So there's a lot of conviction there that that's what they have to do. They could all be wrong. That's entirely possible. But somewhere along the line, somebody's going to have to make a change here. Maybe it's the Fed. Maybe it's the market.
By the way, Steve, that chart, just you can't see it as well as we can. It looks like actually someone's giving you the finger. But anyway.
It's a Rorschach test, Jim.
It's okay. But higher, longer-term inflation in this country, and because labor is sticky, they've emphasized this. Housing costs may come down. Also leads to lower growth. Any just projection on U.S. economic growth at the next couple of years? This isn't a fair exercise for you, but higher inflation isn't good for stocks because ultimately we're going to get lower growth out of this economy.
I think that's right. And in fact, if you want to hear, Tim, the other question I was going to ask Powell, which obviously only get one question, is you notice how he said that labor shortage isn't going away anytime soon? Well, you know how you calculate growth, right? It's hours worked plus productivity. If productivity doesn't change and we have a permanent labor shortage or a secular labor problem in this country, that does mean lower growth for the long term as well. That's something else to think about. I think an environment of lower inflation is an easier environment in which for companies to operate, even though they have done quite well in this inflationary environment. They have, in fact, increased their margins. And so what's going to happen here now, Tim, worth also putting into your spreadsheets there, is as inflation comes down, margins should come down too. So you got to figure that out too.
Yep. Steve, thank you.
Pleasure.
Steve Leisman from Washington for us tonight. How will companies fare in this new environment, Guy? Higher for longer?
I think, listen, how much longer can you pass on your cost?
They're reaching a limit
right?
at this
So when you hear
point. We've seen
PepsiCo
that.
or General Mills, 16% organic growth, which is just code for 16% inflation we're passing on to the customer. How much longer I don't think you can. So to answer your question, margins contract. I think revenues by definition start to contract, so earnings do as well, which means the multiple you pay for all that should be lower too.
I think expenses contract. I think we're going to see a real white-collar recession. Right? The number of job openings for blue-collar is still huge. They're nowhere close to filling that. And yet on the other side, we see white-collar jobs cut every day, and we just getting started. So that doesn't come out in hourly wages, but it is deflationary.
There's a psychological effect, too. If you see people at your company, right, getting laid off, and you're seeing belt tightening at your company, no more travel, no more dinners, no holiday party, et cetera, that gets you to belt tighten yourself in your own household. So there's like a ripple effect here. How do you think about that hitting white collar in particular and the impact on the economy?
Yeah, I think that, obviously there should be some trickle down from white collar down to blue collars, as white collar doesn't spend quite as much. That should trickle down. But I think Karen's absolutely right. I mean, when you look at the labor shortage, it is in the service industry. It typically is in blue collar jobs. The way I always say this is, if you're a hotel and you were able to staff to 80%, right, post-pandemic, and you lose 10% of your business and now you're only 90% full, you don't have to cut, the staff around your hotel. And that's going to be a tough hurdle to climb.
All right. We got an earnings alert here on Lennar. Shares are lower after reporting mixed results for the latest quarter, down 1.4% right now. Diana Olick joins us now with the report. Diana.
Well, Melissa, a mixed picture from Lennar in Q4. EPS came in at $4.55 a share, below estimates of $4.90 a share, but revenue beat slightly at $10.2 billion. Home deliveries were up 13% over last year and in line with guidance estimates given at the beginning of the quarter, but new orders down 15% to 13,200 homes, and the dollar volume on that was down 24% to $5.5 billion. Lennar's cancellation rate doubled from 12% a year ago to 26% in Q4. Lennar's chairman, Stuart Miller, said in the release, our gross margin declined by 270 basis points year over year as we adjusted the price of both our new home sales and homes in backlog to market to reduce cancellation rates and promote deliveries. Now, Q1 delivery guidance is higher than expected, but new order guidance below estimates. Miller added that sales volume and pricing have clearly been impacted by rising interest rates. He did not, however, specifically reference the recent drop in mortgage rates, which are now down a full percentage point from where they were in October. Melissa?
Yeah, it's been a big move. Diana, thank you. Diana Olick. How do you think about that? Mortgage rates are lower, but the outlook for the economy is more bleak.
I think if you're investing in home builders tactically, the last 3 months was a great time to do it. And I think you just had your trade. There's no way I want to be buying Lennar in this environment where I think velocity of home ownership and still getting loans. Michael's talking about where banks are. No, I'm sorry. I understand that on a trailing basis, this is like less than a 6 times multiple, and this is not the housing crisis. But no, I'm not buying housing.
Stock went from 70 to 90 in seemingly a couple weeks, and 90 is basically where we topped out in the middle of August. So this is a natural place to take money off the table. But if 10-year yields continue to go lower, there's going to be a place to buy back this stock. And just looking at a chart, it probably comes in the form of the low 80s. So take profits here, but look for another entry point lower.
Coming up, more on today's big Fed decision, what the Fed's strategy means for the growth trade in the new year. We've got the details ahead. And one media stock taking a big leg lower in today's session. The moves the company is making that had investors dropping out. The details when Fast Money returns.
KiwiCo.com.
Welcome back to Fast Money. With the Fed indicating interest rates will remain higher for longer, we wondered if that means the growth trade will be lower for longer. Big tech has been hit hard by rising rates this year. The XLK SMH Semi ETF both on pace for their worst year since 2008. And the Spider Biotech ETF losing a quarter of its value, its worst year on record. So there's a struggle in store for growth in 2023. I don't know. Karen, where would you stand on that?
Well, I'm short the IGV, which I think of as, growthy, very high growth. And that's and still short because even though things have come in a lot, they were so far in the stratosphere that I think there's still a lot to go now.
Yeah. Tim?
When I think of the mega cap names that have been the place people have sought growth, I still think Google's a place where you're going to get above market trend on earnings growth at a multiple that makes sense. It's going to be probably the best PEG ratio of any of the majors. So the place I get most worried about is in cloud. And think of all the companies that have hinged their future or the last couple of years on cloud. And it's not just Microsoft, and I don't think it's as much about Google, but obviously Amazon and then go on down. And even IBM, which people have given a lot of credit, I think we're later to the game. So I'm worried about the cloud trade. I think it's unbelievably competitive, and I think enterprise at some point will pull back.
You were pointing out Apple and how it hasn't participated of late. Today is no exception. Is it an idiosyncratic story, or is it this notion that rates are higher and people are scrutinizing?
Look, Apple's its own animal without question. Yeah. So I think to a certain extent it's Apple specific. But then you start going down the food chain, and since we'll play the growth game, NVIDIA's rallied, 60% from the 80% from the October low. Think about that for a second. It's probably still down 50% from its all-time high. So at current levels, it's trading at 15 times revenues, which is expensive in any environment, not least of which the environment we find ourselves in. So is it dead? No. But should these stocks still be trading there? Absolutely not.
I think the growth trade was really driven by a massive bubble in treasuries and liquidity, and that's over, right? And so now the question is going to be whether or not you transition from a liquidity bubble and the popping of that liquidity bubble in 2022 to now tech behaving what it really is more cyclical, right? I mean, cloud is cyclical, right? Subscription services, cyclical. Yeah. So that's the big question is what is the earnings story going to be for tech in 2023? 2022 is about the liquidity bubble popping, and I think that's the story going forward.
Semis used to be cyclical also. No longer.
They should be.
I know. That's the guy's point, I think, right? They used to trade at, cyclical.
But then something like Taiwan Semi, which is priced in a lot of cyclicality, and I'll say it again, I think the minute you get that first iPhone shipment warning is probably the time you want to buy Taiwan Semi. But we've said this before, in at least some of the foundry chips and some of the less leading edge stuff, I think it is cyclical. And I think 6 to 9 months before you actually expect to see some reacceleration in the economy, you want to own these things. So it tells me that despite all the tactical rallies we've had, that you want to buy Taiwan Semi somewhere late first quarter, early second quarter, based upon the macro we all just talked about for the last 20 minutes.
Right. I mean, there was a time not too long ago when people were making the case regularly on this network, I'm not talking about our show, that big cap tech was not cyclical. It was defensive. It was in good weather, good and bad weather. It was just going to serve you well in all environments, and that has clearly unraveled.
In a zero interest rate environment, that was 100% true. And then when people started looking at valuations in November of last year, obviously it's not coincidental that so many of the names we talk about seemingly every night all topped out 13 or so months ago, and that's when the Fed pivoted. So again, it's just it's a rates thing.
And tech is competing with fixed income and credit markets. I mean, think about this. Think about Tina. Who's Tina?
I don't know.
Gilligan's Island.
Well, no, I would go Tina Turner.
I was thinking Tina Louise.
Yeah, of course you would.
Well, the other thing isn't the whole story of tech to pay for growth, right?
Right.
And if you look, right, what is the best sector for long-term growth? It's actually energy. So why are we looking at tech for growth?
Tina Yothers on Family Ties.
You know what?
Never mentioned her name on TV.
Deep pull.
Probably since then.
First
Michael
time
J.
on
Fox
Fast Money,
watches.
certainly.
I mean, Karen's friends with him. He might be watching right now.
Could be. A lot of people could be watching.
Yeah, that's true. A lot of things could be happening.
Right. Coming up, shares of Charter Communications dropping hard in today's session. The $5 billion upgrade that had investors losing connection. And more on that next. Plus, have we seen the bottom of the barrel? Oil continuing its bounce, but will prices keep pumping? The huge move our next guest sees coming in the new year. You're watching Fast Money live from the NASDAQ market site in Times Square. Back right after this.
CNBC.
Welcome back to Fast Money. Another check on the markets today. Stocks closing in the red after the Fed raised rates and signaled more hikes in 2023. The Dow dropping more than 140 points, the S&P falling about 0.5%, and the Nasdaq leading the losses down 0.75%. But all three indices still on pace for positive weeks. The only positive sector in today's sell-off, healthcare, led by names like Moderna and Pfizer. And check out Charter Communications. That dropped more than 16% after CEO Thomas Rutledge said at an investor event that CapEx for the year would come in higher than expected. He also said the company will invest $5.5 billion over 3 years to upgrade its high-speed internet network. The company losing $10 billion in market cap just today. Guy.
Go back and look at where this stock was in 2018. Stock was north of $800. Not that that matters, but just for context, north of $800. Look where it traded today. Traded 5 times normal volume. Start doing the math, and Karen and I were talking about it before the show. What they lost today is not nearly commensurate with the amount of money they're going to spend, and the stock has gotten wailed on. Traded 5 times normal volume, very reasonable in terms of in terms of earnings. In terms of PE right here, at probably about 10 times or so next year's numbers. I think this is a capitulation you've been waiting for. I think you can buy the stock here.
And the reason for the capitulation was an investor meeting where the CEO laid out a spending plan that historically, when you think about cable companies, and I'm talking about over the last 30 years, that spending plan was supported by growth and supported by infrastructure and secular tailwinds that we know are everything that is flying in the face of, ripping the cord out or whatever we say. So that's what today was. It was about whether the ROIC in a company like this is worth what they're going to go spend.
All right. Coming up, crude comeback. WTI continuing to climb after scraping the bottom of the barrel a week ago. But as the oil slick over, top analyst Paul Sankey joins us next to lay out where he sees crude heading in the new year. His oil price plus a new pairs trade when Fast Money returns.